This episode is brought to you by Koyfin. Koyfin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koyfin.com. That's KOYFIN.com.
Hit it. It's Friday, October 29th, 2021, episode 154. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show the founder of David Wu Unbound. We have a great discussion of David's time at the IMF, what he thinks the best opportunities out there are in the markets today, and why Squid Game is the perfect analogy of the problems in today's society. Then in Talking Charts, we have a special guest with Mr. Koyfin himself, Rob Koyfman. We walk through the markets and learn about the newest features at his fine piece of software.
This week in trading history, we will discuss the German hyperinflation of 1923, and we end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking today?
So today we are drinking Albertosaurus Tart Fruit Ale by Cambria Brewing Company.
So I got this when I was on my trip this summer, and I did not include the visual of the pack that it came in, but I will do that later. And it is, I don't know how to describe it. It is a bunch of gentlemen that are backpacking high in the mountains during the, early 80s? And when short shorts were very in the rage. And it's a pretty awesome picture. I love it. But anyways, it was kind of a starter pack of all these different Alberta beers. And although we start with the sour, I'm kind of a little bit nervous about it.
Well, it says here, Albertosaurus is sour with a balanced berry sweetness and has notes of raspberry, boysenberry, and black currant.
Well, you know what? This isn't. I wouldn't even consider this that sour.
It's not. It's almost like a grapefruit, though.
Mm-hmm. This is like drinking juice. I'm going to need a couple of these because this is going to be done in like
it is,
by the
and
end
it's
of
a
Talking
little.
Charts.
It's a little small can, like it's the old school. So it's definitely not the big tall boys.
Yeah,
okay.
But it's let's do this.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the awkward arc sparks, the perpetual printing press dystopia, or mad macro mumble rumbles.
All right, let's get to our interview with David.
It's our great pleasure to welcome to the show David Wu, the founder of David Wu Unbound. David, thanks for joining us today.
Oh, you're welcome. Thanks for having me.
It's I'm looking forward to this. You have quite an illustrious career on Wall Street, and now you're off on your own. You have some great insights that I've heard recently. But before we get to those, why don't you tell us a little bit about yourself? Maybe we could go over your years on Wall Street and how you got there.
Yeah, actually, it was never my intention to go on Wall Street, by the way. In fact, you know what? When I graduated from college, I wanted to go into film school. So my parents threatened to cut me off financially if I did. So I found an excuse and got myself into a PhD program in economics at Columbia University, where I thought I was going to spend, some years while writing my dissertation, write a screenplay as well. But you know what? Long and behold, I sort of, that was when I started to get into economics. I started to find actually rather interesting. And after 5 years, I graduated my PhD. I think I was number one in the class, and I got a job at International Monetary Fund in Washington, D.C.
David, I want to interrupt because there's not a lot of, economists / strategists that originally wanted to be filmmakers. Why don't you tell us a little bit more about that? How did that come to be? Was this something you always was, a passion growing up? At what point did you become interested in film?
Yeah, I've always been interested in film. I've actually more interested even in literature. In fact, I've written 2 novels, one of which I'm trying to get published right now. Actually, I've got an agent in San Francisco working on it. But I think the point here is this. I mean, the reason why I'm interested in literature is the same reason why I'm interested in markets. Because both of them are about people. Both of them about storytelling. I think if I'm good at what I did on Wall Street, if I was one of the most successful, macro strategists on Wall Street for the better part of the last 10 years, was because I think I understood what basically people need to hear. Okay. What I'm good at is I'm very good at making facts and numbers accessible to people and make them relevant to people. And I think from that point of view, telling a story, whether it's writing a novel or telling a story in terms of coming up with investment thesis, honestly, I don't think they're that different.
Well, that's a great way of looking at it. Now, maybe towards the end, you can tell us a little bit more about your favorite films, and we can go through that. But let's, for now, stick to the to your career in terms of the Wall Street portion of it. So you graduate with this economics, master's degree in economics, and you go to the
PhD.
IMF. PhD. I'm sorry.
Yeah,
So
I'm sorry. Yes.
You're one of the few guys that has a PhD that doesn't insist on being called doctor.
It's okay. I'm not that pretentious. Who cares?
Well, okay, Dr. Wu. So you graduate from with your PhD, and you head off to the International Monetary Fund. What year is this? And tell me what was your role there, and kind of walk us through what you learned and how that worked.
Right. So I joined the IMF in 1996. Okay, and I was just an economist, but I had a real breakthrough only a year into the job, which was amazing to me. This is why, sometimes, in life, sometimes, you got to be lucky, and in this case I still remember it was, Thanksgiving, 1997, right? Yeah. And there was a departmental meeting, and at which the director of department announced that we're in the middle of the biggest financial crisis the IMF had ever basically seen, which was raging in Asia, if you recall. That was the Asian financial crisis in 1997.
Right.
And then the Korean won had just devalued 20% the day before. And the department director is saying that I need volunteers to basically go to Korea, basically, in 2 weeks' time. Okay? Because we've just been asked to send in an emergency team to help the Korean government to deal with this crisis that was basically, cascading across all of Asia. Okay. And then, everybody looked at each other. It was like, wow, this is Christmas, everybody made plans. It was after that. I mean, listen, I was 26 years old. I was 1 year at the IMF. After the meeting, I went to the director's office and said, you know what? I want to go, even if it means I'm going to just make coffee for everybody. Okay. Because I didn't know anything then.
Right.
And he said, you're on. So believe it or not, Christmas Eve, I arrived in Seoul as the only IMF representative on the ground. And that night, the head of the World Bank, okay, who happened to be there, found me all by myself, took me along on this meeting, private dinner we had with the chairman of the Hyundai Group at the top of the Sheila Hotel. The chairman of the Hyundai Group, the guy would have been 75 years old. There was 3 of us. Yeah. The Hyundai Group guy was sitting on one side of the table, the World Bank guy and me sitting on the other side. I was 26 years old. And in the middle of this meal, it was amazing. There were 3 Hyundai presidents standing in the room because they did not dare to sit down while the chairman was sitting, right? So there I was, a 26-year-old kid. It's true, I was a doctor, but still, I was surrounded by all these people. I was completely shell-shocked. You know what? In the middle at that dinner, the Hyundai chairman, he said, you know what? I got to answer this call. So still back in 1997, it was a big goddamn, basically, mobile phone. He had to basically answer. He went out, and 10 minutes later, he came back. He was in tears. He was crying in front of me. And that phone call was from Kuwait. Guess what? They were loading oil onto one of the Hyundai ships. And because they were short by $1 million, the banks cut their credit line and the Kuwaiti refused to continue to upload the oil. He cried because he was crying in tears. Believe it or not, a 75-year-old man who was the founder of the Hyundai Group. okay, who was crying. He said, I'm so ashamed. For $1 million, this is what happened to us. He started crying, saying that I worked 30 years so that GDP per capita in Korea get to $10,000 basically a person. In the space, I was hoping that the next 20 years we're going to get to 20,000. In the space of basically 3 weeks, it went down to 5,000 because the currency collapsed.
Wow.
That was an eye-opening moment for me. That was international finance. That was the middle of a crisis, and I was right in the middle, and it was amazing. So I had an amazing. I can tell you stories after story at the IMF. I'm not going to go into that because it gets. We can spend all my time talking about it. But that was when I started to get really very interested in international finance, international economy. So my entire career is international. I did a PhD in international trade and finance. I worked at I.M.F, which is about international policies. And then, for the 20 years I was on Wall Street, I ran international teams. Okay. And my focus was especially on foreign exchange.
Okay. So let's just go through though a little bit more through the like 97 and 98. You're in Korea and you stay there for a while. And what did they have you doing? And what were the biggest insights? Like, what did you go in there thinking, this is how I think the world works, but in reality, this is what I've learned?
I'll tell you, people tend to think, people don't have very high opinion about the IMF. I don't have to tell you.
Yeah.
The reason is because the IMF is not popular for a very good reason. Because when the IMF goes into a country, usually that country is in a crisis. No country ever likes the IMF coming in and telling them what to do, especially when you got 26-year-old coming in and telling you what to do.
That's right.
Believe me, I'm sure the chairman of the Hyundai Group was not basically happy to be sitting there with me chatting about his problems. But the point here is this. This is also the reason why the IMF in a lot of these countries stood for I am fucked, right? You only basically bring the IMF when you're basically fucked. Now, I go in, but one of the most amazing things that the IMF did was that, we were able to get countries to implement changes that they did not want to do. Okay?
Right.
For example, because this is the beauty about the IMF, which is that usually when you have a crisis, the government is thrown out of power ASAP. A new government comes in. They have to work with the IMF. And guess what? They can blame the IMF for all the new changes that have to basically put in. So when the IMF says, well, you got to do A, B, and C, which are quite painful, which are good for the countries, but painful along short term, they can say, oh, well, it's the IMF's fault. Okay.
They end up being a scapegoat.
Exactly. And that's why the IMF plays a very valuable role being in a scapegoat. They give basically governments an excuse to do things that they wouldn't have been able to do otherwise. So, for example, I personally essentially drove most of the reform in the Korean, insurance sector. Believe it or not. I mean, the insurance sector was a total mess. There were a lot of changes they didn't want to do, but we were able to basically, listen, there's a reason why the Korean economy in the last 15 years has been absolutely giant. I mean, they've just been doing so well. So much of it is because of the reforms that were implemented in the late 90s.
Okay, David. So you spend, some time in Korea fixing them all up at the IMF. And what makes you decide to leave that storied institution and head over to Wall Street?
Yeah, it was. Very often, love, changes your life. Okay, I met my wife. Margaret Leeds. When I was at college. And she was married previously, and she had 2 kids. She's from Israel, right. And then so she was commuting back and forth between Washington D.C. and Israel. And it got to a point, especially in the late 90s, there was no direct flight. It became absolutely impossible. So it took a real big toll on our marriage. And she said, you know what? You better basically move, or otherwise this is over. So I managed to get myself a job in London. It was tough. But leaving the IMF. But I got a job at Citigroup in London, running basically local market strategy for Europe, Middle East, and Africa. So I took the opportunity and jump shipped.
Terrific. So you were chasing a girl, basically, is why you left. So why don't you tell us about that culture shock? It must have been something to go from what almost is a government institution to the private sector.
Yeah, no, it was. I have to say, it was very tough. I mean, the first year was extremely tough because, the traders that I was dealing with, they didn't give a damn I had a PhD. They didn't give a damn I worked at the IMF. As far as they're concerned, like I was as good as my calls. Okay. And in fact, I was only as good as my call today. Okay. So I think from that point of view, that was the reality, which was fine. I mean, I've learned a tough way. You got to basically at the end of the day, you know what? This is why I have, for example, I have zero respect for someone like Jenny Yellen, who has no track record ever being right. But that's okay, because I think, traders believe in total meritocracy, and that's how I feel. At the end of the day, you get paid a lot of money, okay, for doing what you do, and you better be basically right. That's it.
Yeah.
I think that.
I completely. I don't mean to interrupt there, David, but I echo those sentiments completely. Like I was a young kid on a desk, and they gave me risk, and they didn't care that I was young. They don't care. I always say they don't care if you're white, green, you're a Martian or whatever. It just whatever it is, if you can make the money, that's all that matters.
Exactly. And obviously, I have a little bit more self-respect in that. I want to be right, but also want to be right for the right reason. And that's the difference between a trader and an analyst. Because for me, there's also a question of, if you're right because you're lucky, that doesn't quite count in my book. But if you are right because, you make money because you were actually right, that is amazing. That is what I live for. I mean, there is nothing that gives you more, because, markets is like playing a chess game with except for another 100,000 people. Right. So when you make money for the right reason, not because of luck, because you just basically went along with everybody else did, that is what, that is what that's what really makes me wake up in the morning.
Well, that's awesome. So you're there, and you eventually end up, through, you work for different shops, and you eventually end up as the head of the entire, macro research at, where was it? Was it JP Morgan? I can't remember now.
Bank of America.
Bank of America. So you end up there. So how does that evolution go, play out?
It's actually very interesting. Again, it's a question of, I think if there's one thing I'm known for, is that I'm extremely opinionated. Even though I've got a PhD, I think I do very rigorous research. I am very opinionated, and I'm always looking to take on the consensus. So from that point of view, believe it or not, sometimes, it's okay if you're wrong, as long as you stuck your neck out there. For example, at Citigroup, my worst call ever was a call I made about Hungary. Okay, in 2012, I thought the currency was going to collapse. Instead, the currency actually appreciated.
Okay.
But guess what? The day later, I wrote a long email to all the clients of Citibank saying that I'm so sorry, that my call went wrong, and this is what I learned. And guess what? One of the clients who read the email was so touched, he recommended me for the next big job I got, which is running global foreign exchange research at basically Citigroup. At Barclays Capital. And that was amazing because, again, this just shows you that, you got to be, first of all, honest. On market, I think in markets, because a lot of analysts, they only talk about trades and recommendations, they nail it. Yeah. Right? Nobody wants to talk about the screw-up calls. I'm always the first one to say I screwed up. And I think that sort of made a lot of sense in trying to basically draw lessons. But in the end, I got the big job at Bank of America for exactly that. Because at the end of the day, I think, first of all, there are very few people like me in the market to the extent I've got a PhD, I got public policy at the IMF, and I've done, I speak Chinese, French, English, and Hebrew. If you're looking for someone to represent the international macro part of the business, I think I fit all the bill. And then again, I'm known for having made some big calls, which we can talk about momentarily. But the last 10 years has been really awesome.
That's a fascinating story. Okay, so why don't you tell us, why don't you pick one or two highlights of those big calls and what drove them and walk us through it?
So you could actually Google me, there are a lot of so a lot of big calls I made. For example, one of the calls that I've always been very proud of is 2016. I was basically, I was the only Wall Street analyst pounding tables, say Donald Trump is going to win and the stock market is going to go up, dollar is going to go up, and rates are going to go up. You can basically Google me on that. I got a standing ovation on the trading floor the day that Donald Trump basically won the election. That was amazing.
Okay, so what did you see there that, where did most other strategists go wrong, and what gave you the confidence to stick your neck out and say that?
Because I understood something. Because again, this is why my international experience. As Israel is my second home. In fact, I'm based in Israel now. I was following the Israeli elections very carefully. In 2000, basically, 2015, we had an election in Israel where every poll said that Bibi Netanyahu was going to lose, and guess what? He won by a landslide. Okay, and then a few months later, we had the Brexit vote. And everybody said that Brexit was going to be no. Of course, the Brexit basically vote won. And then that made me realize there's such a thing called what I call the embarrassment bias. There are a lot of people who are too embarrassed to admit, especially to a live interview or over the end of the phone, to actually tell the truth. Okay? Just like in Israel in 2015, nobody wanted to say they were going to vote for Bibi. Okay? And they just like in England, nobody in London certainly wanted to admit they were going to vote for Brexit, was the same reason why a lot of people were too embarrassed to bring themselves to admit they were going to vote for Trump. That was basically back in 2016. 2020, that was even worse. But be that as it may, that was one of the reasons why I thought that Trump was going to win. That was the main reason, actually.
Well, David, Dr. Wu, we're going to have to add a bias to the list of bias, and we'll have to do the embarrassment bias, and we'll put your credit for you. we'll put that into the economic textbooks. Okay, so let's go on. So you're there at Bank of America, and eventually you decide to go off on your own. And why don't you tell us just briefly a little bit about what drove that and what you're doing now?
2020 was a very difficult year for me at an emotional level, philosophically, because what I saw, especially happening in the U.S., the politicization of COVID, politicization of the U.S. election in 2020, basically I found it just suffocated me. We're talking about selective reporting, propaganda, not to mention the cancel culture, which really got to me. So it was at that point I decided, you know what? Something had to be done. Somebody has to do it. It might as well be me. Now, you might say, well, David, you've got a lot of hubris. But you know what? So be it. Because, somebody has to do something about this. Because let's put it this way. My real mission is to bring two things that Wall Street is really good at to Main Street. Okay? Number one, as you said before, Wall Street doesn't give a fuck, about ideology at the end of the day. It only cares about basically making money. In other words, it only cares about numbers and facts that's going to help Wall Street make money. Yep. So I want to basically, once again, reintroduce facts and numbers to the table in public debate over issues that concern our shared future. The second thing about Wall Street is that Wall Street is a celebration of differences, of opinions. If somebody gets to buy Tesla stock one day, it's because somebody else wants to get the fucking rid of it. Okay? So from that point of view, if there's a market at all, it's because people are different. And therefore, I want to basically also explore to Main Street that it's very important for us to be able to disagree. In fact, only by disagreeing are we going to all get better over time. So from that point of view, this is what I'm trying to basically. So I left Wall Street. I call basically I'm bound because because the world these days, everybody has an opinion about something. You get in a room with 5 people, there are 5 opinions. They're operating on one fact. What I want to do is change that. Let's have 2 opinions and start with 5 facts. That's what I want to do.
Okay, so let's get into this. Let's start talking about some different opinions that you have and some different facts. So when you're looking at the markets right now, what do you see as, maybe we could start with, what do you think the market is pricing in with this recent huge backup at the front end of the yield curves throughout the world, and the fact that the stock market is for now just ignoring it?
Listen, let's be honest here. I mean, I think, one of the another reason why I didn't mention why I left the bank in order to launch my own thing, because I realized that retail traders, have become a major force. I don't know to tell you, a lot of your listeners are retail traders. And yet, Wall Street has no idea about anything about these retail traders, and the retail traders have no idea about Wall Street, basically how Wall Street works. So my basically blog is also about creating a meeting place for both the Reddit guys and for the Wall Street guys. Now, there is no doubt in my mind. And listen, so far I've only hired one person, and this person is an MIT math PhD, okay, a Goldman Sachs trained option strategist who's working with me on trying to understand what the Reddit guys are thinking, drinking, smelling, breathing, so we can anticipate them. Because there is no doubt that these people, okay, do not care about where interest rates are, high, low, whatever. The only thing they care about is basically catch up with the Wall Street guys. That means they are buying on dips. And this is why they keep buying. And this is why, I have to say, if we can sit here and talk about divorce from reality, and that's because today institutional investors no longer in the driver's seat. We can see this very clearly in our own data, that basically, because of Reddit, because of social media, these little guys can now basically unite and go in for the kill together. And it's a pretty amazing thing. They can take on the big guys. And this is the reason why the market's still rallying.
And so now we've seen elements of this happen before. You could maybe draw a parallel to the late 90s with the dot-com bubble. Do you think that this will necessarily end badly like that? Or do you see a situation where this is the new reality and we could have years of this going up and with interest rates at zero, like with the TINA, there's no alternative. You could just see more and more people piling in, and it doesn't necessarily have to end badly.
Listen, I think it will end badly, but we're not quite there yet, because this is why timing is everything. To say, well, to say it end badly, you have to first of all say when is going to end badly, and then do you basically put on a trade today to position for ending badly? The answer is no. And partly this has to do with the fact that this is very different from the late 90s. I can tell you, if there's any parallel at all, it's about Japanese housewives. And let me tell you, like in the early 2000s, I don't know if you heard of the term Mrs. Watanabe. Mrs. Watanabe were Japanese housewives that were basically channeling their husbands' hard-earned salaries into basically carry trades. At the time, it was emerging market currency, whether they be Brazilian real or New Zealand, basically dollar. But the point here is this. Before basically Lehman, Mrs. Watanabes were very much momentum traders. They're trend followers, right? Market goes up, they're going to buy. Market goes down. However, after 2008, they became basically counter trend traders. They were basically selling at the high and basically buying the low. And that's actually what's happening with the new crop of retail traders, the Reddit traders these days. They're actually, what I see that based on my analysis would suggest, these guys are not sort of like, basically momentum traders in the classical sense. They maybe short term, there's a bit of momentum, but they tend to be buy on dip and sell on high type guys. And as a result, what they're also doing is crushing volatility. Okay. And crushing volatility is also the reason why risk premium equity's gone down, by the way. Because of these guys, they're sort of buying the low and selling the high. I don't have to tell you, equity volatility this year has been extremely basically suppressed. And this has a lot to do with these guys, the way that they're trading.
So what are you looking at that gives you the sense that they're doing, like I definitely see them buying, and I agree that they're way shrewder than a lot of the kind of old guard Wall Street traders give them credit for. But I guess where I might be, what I'm surprised about your comment is the fact that you're saying that they're actually selling. Because to me, it just looks like a wall of buying, and I don't see them selling. What's the data that looks to, or what are the anecdotal evidence that makes you think that they're selling into the rallies?
I'm not saying they're selling to the rallies, but they definitely take some profit. And you hear people taking profit. These are like these traders tend to be very high frequency. I mean, again, there are different types. I don't want to overgeneralize, right? I mean, there is this sort of the smart dumb money and then the dumb money. I mean, it's this very different thing, all right? Okay, fine. So, I mean, there's no question that a lot of and I don't even know if the Reddit traders all retail. There could be some hedge fund guys who are trying to pretend that they're retail and trying to basically, they might have gotten in the position and trying to basically rev up the Reddit guys to basically get in there to build them out. Who knows? A lot of things is going on. But what I'm telling you is if you analyze the comments on Reddit, these guys are not just basically buy and hold. There's no doubt about that. They tend to go in. Sometimes they take some money off. It's not basically, it's not because otherwise the market would trade very differently, by the way. Okay. You would see much more of a momentum type basically behavior that we have not seen.
Okay, so now with this new reality that you see, this Reddit, and the fact that you're this Reddit domination, and the fact that you're hiring a PhD in math to go and analyze that data, what are the opportunities, and how are you trading differently or investing differently than you might have, let's just say, a couple of years ago?
Yeah, I think in general, I'm more reluctant to be short. Okay, I'm much more reluctant to be short because, again, I can tell you, you could look at every major Wall Street bank over the past 18 months, right? Because everybody's got like a sort of a risk-love model, right? I'm sure a lot of strategists come on your show to say, oh, wow, my model says the market is overbought or oversold, because you've got all these basically parameters that people use using VIX, using, whatever positioning and so on and so forth. All these basically models, I would say over the course of the last 18 months, have predicted at least 2 or 3 times that we were going to have a 10% correction, which never actually happened. Okay. So from that point of view, that has to do with the Reddit guys, because these guys, they don't correspond to these traditional classical metrics. Okay. Because they don't, they operate in a complete, so I'm much less likely to be short. Okay. That said, I tend to stay out of the kind of stuff that they get involved in. Okay. I think, so that's a different thing. My focus tends to be, I'm not a micro guy. Okay. I'm not a stock guy, but what I am is a macro guy. And I think there are 8, 10 major macro themes that interest me that I think are very, very important. And I look for the best way to play these basically 8, 10 themes, either through foreign exchange, either through rates or through individual stocks. So from that point of view, I try not to take on the Reddit guys because, okay, I don't think they're completely rational. So I cannot basically, I don't want to go long what they're buying, but I wouldn't want to go short either. Right. Okay. But I
have a healthy dose of respect for them. Okay. So let's talk about those macro themes that you have. Why don't you pick a couple and let's go through them and explain to us your thinking.
So, for example, I'm very much of the view that we are literally we're just in the very beginning of the COVID's 5th wave. Okay. Now, obviously, we've had 4 waves so far. As I said, in the U.S. numbers still falling. So, I may be early, but what's interesting is this. This is the way I look at it. What is driving the 5th wave, you might say? Now, let me tell you this. If you look at the data, okay, just 6 weeks ago, it was fascinating because if you look at the 38 OECD countries, you rank them according to number of new cases, daily new cases relative to their basically population. The 3 countries that really stood out then was Israel, the UK, and the US. For a long time, I didn't understand what the hell, was going on that, in September, what Israel, US, and UK were seeing the worst, basically, outbreak of COVID of all countries. And I said to myself, what do these 3 countries even have in common? Except for the fact I'm a US and UK citizen and, an illegal resident of Israel. And, I said, well, US is practically a continent by itself. UK is an island. Israel is a sliver of a country. why should they be leading the world in terms of the outbreak of Delta?
Could I just
Now,
jump in here? Can I just jump in here, David, and just ask? It wasn't because you were a super spreader and going to all three places?
Yeah, right, exactly. I think, upon, greater reflection, I came to the conclusion, you know what? It was pretty obvious because these three countries were the first to start vaccinating their population. Okay. Therefore, it was reasonable to assume that their population would be the first to lose the protection from the vaccination because of the waning effectiveness of the vaccine.
Okay.
Now, in fact, I tested this in the data, and guess what? I got a great fit. I mean, I can send you the analysis if you're interested in this. Got published. I published it actually in Real Clear Politics and my otherwise my blog and so on and so forth. So that was why the first to basically get vaccinated, the first off the gate in terms of vaccinating the population, were also the first to lose protection. That makes complete sense to me. Now that's where the three countries started to part ways, because Israel decided to give the booster to everybody. Okay, in the last 2 months. In fact, I got myself the third booster already 2 months ago. As a result, guess what? So anybody over the age of 12 who wants one, gets one. Okay, that's the reason why the number of new cases in Israel has collapsed. In the case of the UK, they decided to give out the third booster to everybody over the age of 50. Okay. However, in the US, the FDA decided to give out the third booster only to people over the age of 65. Now, in my view, this is going to be a problem because as we enter into basically the colder months of the year, this flu season is probably going to be the worst flu season we've seen in several years, because for nothing else, because last year there was no flu season. So therefore, nobody actually acquired any immunity against this year's basically flu. Moreover, in the US, I don't have to tell you, mask requirement has been dropped in 47 states. According to my calculation, within the next 3 or 4 weeks, more than basically 60% of Americans who were vaccinated would have been basically lost the protection from the vaccination because it would have been more than 6 months ago. So from that point of view, I do think that the fifth wave is going to come, okay, as the result of the waning effectiveness of the vaccines. And then I think, you're already seeing that the data in Europe, by the way, in the last 10 days, just in the last 10 days, almost every major countries in Europe are seeing an uptick in the number of new cases. Now, I'm not saying that these new cases are going to kill you. Although in Israel, I have to say, though, at one point this summer, 60% of the people who were hospitalized were actually fully vaccinated people. So when enough people basically get infected, more people obviously are going to be hospitalized, and then you're going to have that same problem. But be that as it may, so I'm very much of the view we're in the very beginning of the fifth wave, and the best way to position for this, okay, is obviously buying Pfizer stock. I love Pfizer. The reason why I love Pfizer is because, unlike Moderna, which look very expensive, Pfizer is trading at a massive discount to all the other major pharma in terms of the 2021 earnings. Especially given the fact, if you look at 2021 earnings, it's like, the analyst estimate is massive, basically down. Okay? Because right now, nobody's thinking we need a third booster for everybody. Nobody's even thinking we might need an annual booster. I can tell you in Israel, the government's already preparing for a fourth booster. If there's, I trust Jewish doctors. That's a Jewish profession. And I'm telling you, Israel is a country for the Jews. Some of the best medicine, best doctors in the world are here in Israel. If they think that it's time to start preparing for the fourth booster, that's good enough for me. So from that point of view, to me, there is no doubt the fact that the only thing we've learned about COVID so far the last 18 months is its propensity to basically mutate, okay? In my case, this is why I think that, whether you think that the fifth wave of COVID is going to be disruptive economically or not, we can talk about that. But I think at a minimum, it will basically force governments to basically give out the third booster to everybody. That in itself will be good enough to drive basically Pfizer probably towards this basically the year high.
Well, so David, you did warn us that you were going to be politically on the edge, and there we go with our first comment. So listen, one of the fascinating insights that you had that I heard about what an increased amount of people getting COVID means in terms of the demand, but more importantly, a supply shock. And let's take this back to macroeconomics. You've spoken about what this means in terms of inflation. Why don't you walk us through that theory? Because I do think that it's something that is very relevant in terms of understanding what might happen if your scenario plays out where we have a big fifth wave.
Yeah, because my view is this. My view is not even so much the fit. I'm very much of the view that we are entering into the age of stagflation. And my view about stagflation is associated with COVID as a negative supply shock. Now, you have to understand this. Almost 30 years now since I did my PhD. When I was doing my PhD, like Keynesian economics was like up and coming, but they did not own economics. But they come to own economics in the last 20 years, the Keynesians, because almost every recession in the US has been brought on by a negative demand shock. Right? I mean, whether it was like September 11th, bursting of the IT bubble, or even Lehman, that was a negative demand shock, which meant that, as you went into a recession, inflation also came off sharply, which then warranted very aggressive fiscal and monetary policy response. That's why people like, Janet Yellen and Powell, like their instinct every time as we went into COVID was, well, let's basically ease fiscal and monetary policy, because they assumed that, it's like, I liken this to the doctors that killed George Washington, right? Basically through essentially the bleeding him to death. Because the problem is that until the 18th century, doctors, the only medication they gave out was basically, bleeding the patient, whether they had cancer or they had just basically a common cold. That's the problem. So the reason why I brought this up is because COVID is a negative supply shock. It's the first time in 30 years we're dealing with a negative supply shock. And I'm not even talking about the fact that used car prices are now higher than new car prices because they can't get basically chips. That type of supply shock is going to ease. I'm talking about something much more fundamental. I'm talking about the fact that since I think COVID is going to be here to stay, again, I'm thinking it's not just a fifth wave, it's going to be a W-shaped recovery. We're going to go through periods where, we're going to crack this and then things are going to get better and then things are going to get worse. It's going to be one of those things. What COVID has done, three things in terms of negative supply shock to the labor market. Number one, it's created a massive skill mismatch. Okay, think about this, right? During COVID, even now, why do you think the unemployment rate for people with only a high school degree is like over 7%, whereas unemployment rate for people with a college degree is basically barely above 2%. There's a reason, because if you have a college degree, there's probably a better chance you can actually work from home. There is no question that the fact that there are all these job vacancies, even though unemployment rate is still at basically 5%, people are struggling to fill the vacancies, is because there is a skill mismatch created by COVID. And that's the reason why wage growth is picking up. That's a serious negative supply shock. The second basically negative supply shock having to do with, female labor participation rate. Again, I mean, now it's true they're now going to basically roll out the vaccine for 5-year-old. I don't know how many actually parents are going to literally voluntarily allow their kids to basically get vaccinated at the age of 5. There are a lot of doctors who are against it, by the way. But the point here is this: as long as not every child goes out and do this, I can tell you there's no doubt a lot of women left the labor force. In fact, female labor participation rate dropped 2% because preschools are closed and that kind of thing. Women are spending more time at home looking after their children, especially those. And by the way, Delta does basically infect children. I can tell you until basically 6 weeks ago, about 50% of the new cases in Israel were children under the age of 15. Okay? So to me, I think women labor participation rate is going to be permanently lower as a result of possibly COVID here to stay. The third thing, of course, there's no doubt about this, is the fact that, I think another thing COVID has done is made people realize that money is not everything. we all, people spend more time at home with their family. This is why I'm bullish on real estate, because people now realize, there's nothing more important than your family, okay, and your dog, possibly, okay. So therefore, people are not going to be working as hard as before. It's not going to be as cutthroat as before. They're less. I think the labor supply in general is going to be less price inelastic. People are going to demand greater flexibility. All these things are basically represent negative supply shock. Now, of course, on top of that, ESG and Biden is creating additional negative supply shock. Because let's put it this way. I mean, the only reason why oil prices are now $85 a barrel, okay, the highest in 5 years, is because every bank is afraid to lend money to the oil basically drillers because they might be labeled as being energy unfriendly. They're afraid of basically protesters or Democrats camping outside their headquarters, calling their depositors to boycott their banks. That's what's going on. As a result, even though oil prices going up, U.S. drilling activity is not catching up because everybody afraid to drill. That is a negative supply shock for no very good reason. And that's what I always said. ESG, I don't know if ESG is going to save the planet or not, but I'm pretty sure it's going to be responsible for bringing on the next U.S. recession.
Okay, so how, given your view in terms of the supply shock, how do you set up a portfolio or a trade or an investment to take advantage of this?
Yeah. So, for example, I actually like owning ExxonMobil. I like basically owning Exxon because, for a pretty obvious reason, because all this ESG stuff, okay, which is discouraging, okay, basically drilling activity means oil price is going to stay high. And now the new credit constraint faced by the oil industry is going to be felt so much more acutely by the little guys, by the new guys on the block, which means that the bigger players are going to be able to enjoy simply higher prices. And the great thing about these oil majors is because they're trading at ridiculous multiple because nobody wants to basically buy them. Institutional guys don't want to basically own them. That's where you can buy ExxonMobil and get 5.5% dividends. Amazing.
Yeah.
So from that point of view, if you think, and I'm in Saudi Arabia, wouldn't even answer the phone call from Biden these days because Biden is like, well, listen, oil price is going up. Let's get the Saudis to produce more. The Saudis literally telling him to go fuck himself because the Saudis, from their standpoint, is the U.S. wanted to basically help Iran to restart the nuclear program. They're saying so from that point of view, you've got a great situation for ExxonMobil. The Saudis want to basically produce more. Right now, Iran, doesn't want to even negotiate with Biden anymore because they figure who knows how long the Democrats are going to stick around. But the point here is that I think owning basically oil as a dividend play is very attractive. So I think about the big oil players no longer as like an oil energy sector. They're almost going to be like high dividend utility play because I think oil price is probably going to be much more stable going forward. It's probably going to be somewhere between 70, $100 basically for a very long time, low volatility and basically high dividend. Why not own that? I own that. I own basically Pfizer. I think, these are very good way to basically play for, I think, the new paradigm.
And do you think that, in the macro community, one of the go-to trades used to always be to go buy bonds or short rates because, as you mentioned, every time you saw a situation where the economy got into trouble, we saw rates go down and we saw the Fed cut rates or central banks throughout the world cut rates. Do you think that macro go-to trade is gone now? And do you think it has the potential of hurting people?
No, I don't. I do think, all else being equal, the Fed is going to be hiking rates next year. I have no doubt about this. All else being equal. Listen, I hope I'm wrong. Listen, if we don't see, unless we see a recession next year, I think the Fed is going to hike more than what's priced in.
Oh, you do? So you think that the short end is like right now, the short end, I guess like everyone's fighting about the June contract of next year of whether there's going to be a hike or not. You would actually be a seller of that contract, meaning that you think that there's a greater chance that they might actually start earlier and
no, I don't think we'll start earlier than June because they're going to stop. If they start, their plan is to start tapering in November.
Yeah.
and basically end tapering in June. So they're not going to basically start hiking rates already in June. I mean, the day that they stop tapering.
Okay.
But they will. But in my view, there's probably a good chance they're going to hike 50 basis points next year. Okay.
50 basis points in total, not 50 points. Like, you don't think they're going to go and get out ahead and try to do like in the old days when we were first starting, David, you and I were about roughly the same age. There used to be 50 basis point hikes. And then it wasn't until, the Fed went and did that kind of Greenspan every meeting they did a quarter. And that kind of got everyone conditioned to that they never would do 50 more than once. But do you think that there's a chance that we actually get to a situation where inflation's running so hot and the economy is running so far that the Fed is actually forced to do more than 25 at a crack?
I don't see that right now, because if they did that, the stock market will crash and there will be no inflation. Okay. Let's put it this way. I have no doubt. Listen, the Fed is going to be in a very difficult position. And this is why I'm very much of the view. I think within the next 18 months, sometime in 2022, I think we will see a stock market crash. That's my view. Again, it's not something I would position for today, but it's going to come. Because these Reddit guys who are completely unhinged from reality will eventually have to come crashing down. Just no doubt about that. But I think there's no doubt a trigger could very well be the Fed. Now, let's put it this way. The bond market won't just be looking at the Fed. The bond market is going to be moving ahead of the Fed. If the bond market see inflation really going up, bond yield is going to come unhinged.
Right.
So from that point of view, the bond market will tighten for the Fed.
But that would be enough. What's interesting, though, David, right now is that the central banks, or like the bond markets, are predicting that the central banks will tighten, and they're bringing forward rate hikes. But yet the long end is actually declining in yield, meaning that they think that that tightening will cause inflation to be curtailed and the economy to roll over. So do you think that maybe the trigger to your potential stock market kind of unhinging or let's say rehinging back to reality might be the moment that the bond market realizes that the Fed hiking 1 or 2 or 3 times isn't actually going to stop inflation?
Listen, Kevin, I think, I hear your interpretation, which is the sort of the popular interpretation of why the yield curve has sort of flattened at the long end. I don't think that's the only explanation. The other explanation is, we're going to have a global recession. We're going to have the global growth long term is going to be much lower. And I have no doubt, because there is no question. For example, I can tell you already now, the midterm election next year, the Democrats are going to get destroyed, which means we're going to see the mother of all fiscal tightening already kicking in 2023. Just like we saw after the midterm election in 2010. We saw 5 years of fiscal tightening. Okay. When you have this right now, like even now, the Democrats own Washington. They can't even pass the damn basically package they want to. Thank God. Joe, by the way, Joe Manchin is my hero. He's going to save America. But let me tell you this, the bond market is absolutely right. After this, right now, if the economy is doing well, it's because all these checks, all this money that the U.S. government has been sending out to everybody, right? All the Reddit traders, what money are they trading with? Basically, all the government assistance check that they got last year, which they put in the stock market, right? That's the reason why, the U.S. government debt now is $27 trillion. To me, it was almost, it's ironic when they were talking about billionaire tax. Think about the billionaire tax. If you take all the billionaires in the United States, the total net worth only is worth $4.3 trillion. Our debt is $28 trillion. If you could confiscate every single dollar from every single billionaire, you won't even make a dent to the U.S. fiscal indebtedness situation right now. That's the irony of this.
Sorry, I don't mean to interrupt, but David, are you saying that the stock market then goes down because we actually see the recession? Is that what scares you?
I think so, yes.
Oh, okay.
I think so. I think the stock market is going to go down for pretty obvious reasons. Because for one thing, you're not going to get, by 2000, let's put it this way, forget about in 12 months' time, even by 6 months' time, all the fiscal stimulus in the system would have largely played out.
Right.
Okay, a lot of it will play. Certainly by 2023, that the long end of the yield curve is, we're talking about 30-year curve, right?
Yep.
Certainly by 2023, I would say after the midterm election, I think the fiscal policy is going to go from expansionary to contractionary. By then, interest rates will be higher. By then, by the way, the only thing I can tell you that basically that there's a bipartisan support for is go after big tech, and rightly so. Right now, the top 10 most expensive companies in the United States account for 25% of the market cap of S&P 500. It's never happened in U.S. history. It's never even happened that the same companies, the top 10, were the top 10 basically 5 years ago, 10 years ago. It's never happened. Even the Chinese are now cracking down on big tech because they realize that big tech is basically stifling competition there. Believe me, Lina Khan may turn out to be the best appointment that Biden has made yet. So I'm going to also have to assume there will be some actions taken against big tech over the next 12 months because that is the only thing where there's some bipartisan. So I can see a lot of different things. That's why I'm telling you, if the long-term bond yields are not going up, it's because people, I like to think that the bond, because thank God Reddit traders are not involved in long-term bond yields. I would have to assume that the long-term bond market is still more rational, pays more attention to the fundamentals than the Reddit guys understand.
Right. And there's that famous saying that the bond guys are always smarter than the equity guys. They're more rooted in reality. So maybe this is a case where the bond market realizes what's going to happen, as you say, a couple of years out or after 2023, and that's the reason the bond market is actually under control. The long end.
That's exactly it.
Okay, so David, let's get on to the kind of questions that I always like to ask people at the end of the interview. Let's start with your favorite investment book.
My favorite investment book is a book called Predictioner's Game. Predictioner's Game, actually, because I teach. I taught at George Washington University a couple of years. A course on political risk. I also teach at the local business, the best business school in Israel. The same book I use, it's a textbook I use called Predictioner's Game. It uses game theory, to basically think about basically the world. Because a very important part of my whole analysis is this. I'm an economist by training. For much of the, in the 2000s, we live in a world in which economics was driving politics. Okay. The last few years, it's become very clear we now live in a world in which politics is driving economics. So you cannot really, you have no idea what you're doing. Again, I'm not talking about making money because you're lucky. You're doing what everybody else does. I'm talking about you're actually right. If you're right about economics, it's because you're right about the politics. And I think the best tool that I think for people like myself in terms of understanding what predicting outcome in politics is basically game theory. And then Predictioner's basically Game is actually a very nice book that puts game theory in context for people who want to understand how to basically make predictions in a very complex political setup.
So, David, one of the things that I meant to ask you about that I'm extremely interested in is that you mentioned that you're calling from Israel and that you're married to an Israeli woman, and I've heard you talk about in the past about Israel as one of the greatest investment opportunities from the real estate side. I'd love to hear your thinking why you made that statement.
Yeah, I think first there are three main reasons for this. And by the way, I just want to say, just for full disclosure, I own a lot of real estate in Israel. But be that as it may, there are three reasons. Number one, Israel is a very small country, and yet it has the fastest growing population. It's pretty amazing. People don't realize this, but the birth rate in Israel is closer to 3%. In fact, this is not just for religious women, but also secular women. And, because this is a country of love and life. People love children, and people are having lots of children, and it's amazing. And I think from that point of view, this is a very important reason why this country is going to get more and more crowded. The second reason is I'm bullish is because, not for a very good reason, but because of rising anti-Semitism around the world, including in the U.S. Jews in Europe and America feel increasingly uncomfortable being Jewish. So what we're seeing is more and more Jews moving to Israel, believe it or not. I mean, especially from France, from the UK, even if they don't move here permanently, they're buying basically, a piece of the Holy Land so that in case that they have to basically escape, they've got a place to stay. That's a reality a lot of people don't realize, but with anti-Semitism on the rise, very bullish for Israeli real estate. The third reason why I'm very bullish for Israeli real estate is because the culture here, the high-tech culture. By the way, 8% of the workforce work in high-tech. I'm not talking about secretaries. Okay. In fact, you know what? The finance industry practically doesn't exist here because everybody who wants to get rich, they go into basically tech. And the entrepreneurship, the startup basically culture, it's just incredible here. And, so from that point of view, and this is also the reason why, by the way, Israel did so well throughout COVID, because the whole tech industry does not have to basically work at the office. Both my son-in-laws basically work in high tech, and it's an amazing thing. So from that point of view, tech is growth. There's no doubt. There are 300 companies in Israel just doing basically, AI driving, driverless cars, believe it or not. So the amount of basic creativity that goes into tech and tech development, that's going to continue to grow. So from that point of view, Israeli real estate just to me is a no-brainer. It's one of these things that this is the fastest growing economy in the world for the next 10, 20 years. And especially now because of Trump, Israel's made peace with the Gulf countries, with UAE, with, I think, a peace deal with Saudi Arabia probably is not that far off. I think you're going to have a lot of Gulf money also coming into Israel, whether it's commercial or residential real estate. I mean, this place is going to be booming for as long as the eye can see.
I love it. It's a very out of consensus and not something a lot of people talk about. Thanks for sharing that with us. Now I'll finish up with the last few questions I always have for our guests, and I'm going to give you the one that I've introduced recently. The great Byron Wien, he has something where he talks about his big surprises for next year, and his surprises are defined as something that the market thinks that there's a less than a third chance of occurring, yet he would attribute more than a 50% chance of that occurring. And I was wondering if you could come up with a Byron Wien surprise for 2022.
I think a big surprise. I think there's a greater than 50% chance that I think we will see U.S. core CPI basically go above 3% and stay there for 3 months in a row, and that's going to scare a lot of people. And the way we're going to basically do that is going to be because of rent. In my view, rental inflation is going to be edging higher. As you know, core PCE, which is what the Fed focuses on, basically the single biggest component is basically housing. And the biggest driver of housing inflation is rent. So from that point of view, I think there is no doubt, to my mind, that one thing that could take the stock market down is that core inflation really goes above 3% and stay there for a while. And I think I think that is something that I personally will give it a 50% chance of 2022.
Okay. And then the last question for you, David, is if you were going to counsel a young person that was interested in this business, what advice would you give them?
I would say stay away from Wall Street. Okay. And the reason is very simple. And you know what? I think a lot of people don't realize, I think, listen, I was very lucky. I did very well on Wall Street. I retired at 50, and even though I'm even in research, okay, the days that you could basically go to Wall Street and retire at 40 or 50 is forget it. It's never going to happen again. Okay. Wall Street pay is going down. The reason is because Wall Street jobs are going to robots. If they haven't gone to robots, they've gone to India. And I'm telling you, they're going to, because what Wall Street does can be digitized, could be basically codified and done by robots very easily. This is what people don't realize. Traders, more and more traders' jobs are being taken over by basically robots. Salespeople's job being overtaken by robots. The only jobs that haven't been completely taken over are basically analysts, okay? But increasingly those jobs are going to basically India, okay? Now, so from that point of view, I would argue that the days that you're going to basically make above average pay working on Wall Street is over. Now, it's true. I mean, you might as well. I think from that point of view, I personally think young people, if you really want to go to Wall Street, you have to realize that, the time that basically everybody, let's say because there was a time that if 50% of people going on Wall Street did well. I would say now 5% of people on Wall Street are going to do very well still. So if you're that good, you're going to be one of 5%, you're still going to kill it. Then you should definitely by all means go to Wall Street. But for that, you need to have strong interpersonal skills. You have to have very, very high IQ, very high EQ, emotional intelligence. And you have to be passionate about the market. You have to be willing to basically put your neck on the line. All these things, most people are not. Okay? So if you think you're going to get a job on Wall Street and have a cushy life and be able to retire at 45 or 50, forget it. That is completely over. Okay? And then if you are not going to be one of these top 5%, go to Google, go to work at Apple. Because I can tell you the last basically 5 years, when I basically recruit top PhDs coming out of MIT, Harvard, and Stanford, my biggest competitors in the job market are Google and basically Apple and Facebook. These guys pay you a lot of money and work relatively short hours, stress-free, and you get stock option, all that kind of stuff. Okay? If you want a cushy life, go to Facebook and Google rather than go to Wall Street. If you really, that's my advice.
Okay, so that's good advice, David. The last thing I meant to ask you is that you mentioned you were a film major. You were going to be a producer or a film director, and I was wondering if you could give us maybe your favorite movie of all time that's kind of off the beaten track, or maybe something great that you've seen recently that you could recommend.
Listen, I mean, I've got a lot of favorite films. I love films from the French films from the 1940s. So I don't want to bore your tears off. So forget about that. But I did watch Squid Game, and I thought that was very interesting. Obviously, it's a very well-made film. But I think the fact that I, together with 200 other million people, watched it, were entertained, and there now people were inspired by it, I think that's what's interesting, because I think great art is supposed to echo the age, our time. And there is no doubt the biggest basically problem, the biggest zeitgeist of the age is income inequality. Okay? It's the fact that you got all these billionaires and people say, why can't I basically get there? The fact that basically, and that is what this is all about. And I think income inequality is the reason why we've got these Reddit traders, because the Reddit traders think these Wall Street guys got rich because they know something they don't. And they're just trying to play catch up by basically pouring their money, trying to play catch up. So from that point of view, there is no doubt that income inequality is the biggest problem in our age. And I think, and then unfortunately, most of the people, middle class even, have a totally distorted view about what really rich means and how do you become rich. And I think from that point of view, personally, I think this is the reason why I think ultimately where we're going to end up is basically, I'm very, very worried about socialism being around the corner. I mean, and we saw that lately with the German election, with the Canadian election, decentralization of politics, which is fragmentation of politics. The U.S. perhaps it will play out differently. Maybe it's going to be about secession, whatever it is. But I think, Squid Game really speaks loudly about, I think, the fragmentation of our society between the rich and the poor, and the misperception about the poor, about the rich by the poor, that I think, this is ultimately going to do us in. But, there's no doubt this is the biggest, basically, problem.
That's a fascinating take. Now, David, for those who want to learn more about, how Squid Game is a reflection of our society and maybe get some tips in terms of what's happening in the markets and learn about your many decades of experience, where can they, reach out or what website can you send them to?
Sure. So my blog is called davidwuunbound.com. So simple as that, davidwuunbound.com. And my whole mission is to basically provide the best of Wall Street research that's affordable to retail guys. Let me tell you this. I'm charging people between $50 a year to $150 a year. Wall Street people, I just tell you, like I just saw one of the biggest hedge funds in the world just basically signed up today. And they were laughing in my face. They're saying, David, you're selling yourself so cheap. It's amazing. I say, you know what? Yes, I'm selling cheap because I want to make it affordable for the general public. Because the whole point here is that there's no reason. And I think, at this point, I've reached my own fuck you point. I don't need to make money. I just want to make the world, a better place. My wife said to me for the last 20 years, every time my wife would introduce me at a party, she would say disdainfully, "Oh, wow, my husband's job is to make rich people even richer." Okay? Something I'm not very proud of, but now I want to bring something else to everybody. But the most important thing is this. This is a global forum for honest dialogues about our shared future that starts and ends with facts and numbers. And my job is to make numbers and facts accessible to everybody. You don't need to I have a PhD so that you don't need a PhD to understand what I'm saying. If you don't understand what I'm saying, then it's my fault and not your fault. Because my job, my mission is to make numbers and facts accessible and relevant to as many people as possible, and proposing a point of view that make you think and make you disagree, because I'm not always right, okay? I want people to come challenge me and challenge each other. And again, regardless of your experience, your politics, your nationality, I welcome everybody, except I ask you to leave your feelings, your prejudice, and your ideology behind. That's it.
That's awesome. Well, David, I wish you all the best of luck. Everyone go check it out. David Wu Unbound. Thank you so much for your time, and we really appreciate it.
Thank you, Kevin, for having me on. Really appreciate it.
All right, Patrick, it's time for Talking Charts. And before we get Rob on the show, let's quickly go through our top 3 of things that we were watching last week and go through what we will be watching for next week.
Right. So last week we were talking the top 3. Will the markets make 52-week highs? And well, that didn't take long.
No.
I mean, it just started right out of the gate with a fresh high on S&P, and it hasn't quit. And we closed today above 4,600. So yes, 52-week highs are here. Number 2, we were talking about central banks, and boy, did Bank of Canada come out hawkish.
Oh, it surprised the whole market. It caused reverberations throughout the entire front end of the fixed curves globally.
Yeah,
they seem to be one of the most hawkish central banks out there. And how
many central rate hikes were they talking for? Right,
I can't remember, but I did look. I was doing a little bit of work in terms of looking at the move in the backs, which is the equivalent of the Eurodollar futures, which is the short term 3-month interest rate future, and it was one of the largest moves we have ever seen for the 4th contract. I think the meat of the move was in terms of where the decline was most pronounced was in the 4th contract. And I looked at it, and there's only been one time over the past 20 years that it had declined as much as it had today. That time back then was during I believe it was during the Great Financial Crisis, and I think that the reason that happened was because of credit as opposed to an interest rate move. Yeah. So this is a shockingly large surprise hawkish move from the Bank of Canada.
Do you have anything to say about the ECB?
The ECB came out, and although they pushed back on what the market had been pricing in terms of rate hikes for next year, they didn't push back enough, and the market was surprised by that. And it was kind of they took it as an excuse to sell the front end of the ECB curve as well, which is kind of shocking because the ECB seems to love their negative rates, and if before we know it, we better watch out, or we'll see a situation where the market will price out the negative rates.
Yeah. So our number 1 was looking at earnings and what it would do for the markets. And while there was certainly some volatility, some big moves in things like Starbucks and Visa to the downside, but
Apple and Facebook.
Well, I was about to say Apple.
Oh, sorry.
So yeah, Apple and Amazon though they both
that's right.
gapped
Amazon.
down. They both gapped down, and they both ended up actually rattling into the close. And while Amazon didn't turn green on didn't undo all of the losses, it pretty much recovered most of it. And Apple ended up coming all the way back, and Microsoft didn't even look back. Like it just kept ripping, and so its earnings didn't turn the markets, that's for sure. And even the ones that disappointed, I mean, other than ones like Visa that just never were able to recover, at least the FANGs, which are the big market cap behemoths, certainly didn't take it too badly.
Bad earnings were just an opportunity to buy. Shopify was another one. Came out, bad earnings, and the market just said, nope, we're going to look through that, and they scooped it up like nobody's business.
Like nobody's business. All right, top 3 things to watch this week. Kev, because you weren't involved, I had to put it in there.
This is what happens, folks, when I don't actually get involved in the top 3. Patrick gets his opportunity to squeeze in the dollar.
Okay. All right. So, but listen, I just thought that was really interesting price action we just saw in the last few days.
Of course you thought that.
No, but like, look, okay, look at that screaming green candle, screaming, just like, it's just like it's screaming, but like,
that's like what you people name their monster trucks.
Yeah.
Screaming green candle.
But what it was interesting was the pop and drop on the euro particularly, and this is the one I wanted to highlight. The euro has more or less since May been in a very pronounced downtrend. Like this is an ugly chart. You can't put a positive spin on this.
Yeah, even the mother or father of this chart would have to agree that this is ugly. It's like, how everyone likes to think their baby is the cutest baby around. Even whoever gave birth to this chart, even they're saying this is one ugly chart.
One ugly chart. And so, but what we have is that on the first reaction to the ECB, it popped. And it headed toward 117, and a lot of big questions as to whether that was enough to turn the tide. And today just got slammed.
It almost looks like that noble animal, the prairie dog, on a shorter time frame.
It does, yeah. And so one of the things I think is to watch is whether or not that euro breaks to a lower low. I think you sent a note saying it doesn't.
No, you were asking about, I passed along some research that I think that was from RBC's New York desk, some kind of color. Can I give you my opinion of what happened today? So
please,
if you think about what's occurring throughout the world with central banks, you see that on a relative basis, the Federal Reserve is actually one of the least hawkish banks out there. They're not the ones leading the charge with all these rate increases. Who is? Australia, Canada, Poland, Brazil. Everybody else, and a lot of them, by the way, are commodity exporters. A lot of those countries are leading the way with rate hikes, and the U.S. is not. And so what I think is happening is that we saw today, given the monetary stance on a relative basis, it is very loose in the U.S. We see that money is chasing U.S. stocks. And even though, given the outperformance of stocks versus bonds, you would have expected today to be a big sell with the rebalancers on today's, that whole mythology about, depending on the relative value of bonds and stocks, the pension funds rebalance towards the end of the month, and you see these big flows. You would thought that there would have been a lot of sellers on the rebalance theory. In fact, we see that there was a huge amount of buyers. And to me, I think that's because international portfolio managers are looking at the monetary stance, and they're saying on a relative basis, the U.S. is going to be the least hawkish, and so we're going to chase U.S. stocks. It doesn't hurt that they're also already going up, so you already have positive momentum going for it. And I am never one that sits there and says currencies move because of interest rate differentials. I think that's there are times that it moves that way, but on the whole, that is the kind of, I'll just take the other side of that. It just, most of the time, it doesn't matter. Whether Canada is 25 basis points tighter than the U.S., think about how much the Canadian dollar moves on a daily basis. It moves the entire interest rate differential on a daily basis almost every single day. Yeah. So to me, the relative rate differentials only usually matter at extremes or as sentiment changes amongst them. So to me, what matters more is portfolio flows and obviously direct investments. And so what I think's happened here, I'm rambling, but I think what's happened here, Patrick, is that there's been a mad scramble into U.S. stocks this week, and that's why the dollar's going up. So I will take the other side of your trade, and you're all bullish on the U.S. dollar, and you think that this is the start of a new trend.
I'm not bullish the dollar.
You are always bullish.
Euro.
Let's face it.
I'm just bearish the euro.
Okay, well, listen. You know what? You can do the bet because I lost this week, but I'm telling you right now that I'm not as bearish the euro as you are. Anyways,
Okay.
that's my opinion.
Right.
Let's go on to number two.
Number two, we had to talk about that jobs number coming on Friday. And the one thing I wanted to highlight is that we're just seeing such huge volatility. And it's hard to see these things come down the middle. Like it's like either a huge beat or a huge miss almost every single month, isn't it?
Well, there is a lot of economic volatility because there's a lot of uncertainty out there in terms of how
and
things
I think
are
it's
operating.
also it was just the post-COVID period where there's just so much turbulence with things. Like it isn't a steady economy right now. It's still an economy that's confused in terms of how reopening looks and which businesses are doing what. It's anyway.
Can't disagree, and you got to watch the unemployment numbers next Friday.
Yeah. All right. So number one, the FOMC coming up next week.
Yeah.
What do you don't think they're going to do the hawkish tilt?
Well, first of all, they're going to do their taper. So that's done. And I think that's pretty clear that they're going to taper. They're going to
That's been priced in.
They're put it on time frame to go for what is it? The middle of the next summer that they're forecasting for that. So the real question to me is, why did they tie their hands so badly in that they firmly believe you cannot raise rates while you're doing QE? And I understand the logistics of it, because to them, QE is stimulus, and therefore, why would you raise rates while you're doing stimulus? So I get they're thinking about it, but can we all agree that QE really doesn't do that much? It does in terms of, at least in terms of the real economy. And once we agree on that, why can't we move rates while we're doing QE? Like from a functional point of view, there's no reason why they can't.
Yeah.
In the old days, they couldn't because they didn't have the interest on excess reserves. And so therefore they had issues and they couldn't do it therefore. But now with interest on excess reserves, they can do both. And I know this is a long shot. There's very little chance that this is going to occur. But I think that at the very least, I think you're going to start to see even the Federal Reserve get nervous and be concerned that by waiting all the way till next summer before they can even tighten, that they're going to be behind the rest of the world.
Right.
Right? Because if you think about it, everyone else is going to go. Canada's quit their QE, and I think we're going to start tightening. You know, we already see Poland raising. We already see Brazil. The rest of the world's going to go because of this hand tying that they've placed on themselves. They're going to be the last ones.
Yeah.
Anyway, so it's something to watch. I think at the margin, though, Patrick, that
I think it will drive the next currency move. I think that in some degree or another, number three is going to be tied to number one. I think that the tone from which people take away from that will potentially either drive the breakout in the dollar or the fade. I think they're all intertwined.
And I'll tell you what I think that they're probably more concerned about than the real economy. I think that they're probably more concerned about the speculation that's occurring in the stock market. And
yeah, you think so, eh?
Yeah, I still believe that. If you go back to when Powell first took office and you read his speeches, he spoke numerous times about how the pain from cleaning up a bubble that had burst was way greater, and therefore you should go and you should cut the bubble off ahead of time. And no, really,
I'm thinking of the irony.
I agree, because then he completely switched. He went from like the Powell. Remember, we're a long way from neutral. He came in there. He was very hawkish. He was going to show everyone. He was going to make this, burst this bubble. And then he's completely switched. And that's why the average inflation rate targeting was such a dramatic shift for him.
Yeah,
because he had been quite hawkish. And listen, that this is typical when a central banker comes and first takes over the job. they often want to prove themselves by being central bankerish, and they end up being too hawkish. And I suspect,
and now he just doesn't want it to blow up on his watch.
Yeah, I suspect this is part of what's happening in Canada. By the way,
Yeah.
It's the exact same thing. We have a new governor, Bank of Canada governor here. It's the exact same thing as when Powell came in and said we're a long way from neutral. Anyways.
Okay, let's move on.
Let's bring Rob onto the show.
So joining us here for the second half of our Talking Charts is our good friend, Rob Koyfman. How are you, buddy?
Hey, how's it going? Glad to be back.
Oh, well, listen, Rob, we're going to talk some charts. And actually, I have some different equities and things I want to look at. But Kev, I think we need to jump to some of these rates, right?
Yeah, and we're lucky enough to have the master of the Koyfin with us, and he is driving the bus, so he's going to be able to walk us through all the different things that it can do. And so let's get right into it, because I think that there's been a lot of action in the fixed income market. And for a lot of the equity traders, they probably felt like today was a pretty boring week. But for anyone that was trading short-term rates, this was anything but. Why don't you show us some examples of all the carnage that occurred at the front end of the curve throughout the globe?
Yeah, so let's pull up our favorite dashboard, the Global Yields dashboard, which you could find under Market Dashboards, Global Yields. And basically, we have all the yields here organized by you could organize it here by tenor or country. So I just grouped it here by maturity. And so that way we can look at kind of is the 2-year the thing probably the most representative where we want to look at?
Yeah, so it was a lot of 2s, and there were some pain in the 5s. And then, as we go through it, what will be interesting is to show how the long end behaved completely different. But first, let's just kind of show, maybe we could start with the UK, because the UK, to some extent, out of the developed markets, or out of the kind of, let's just say, senior markets, it was one of the first senior markets to really get hammered at the front end.
Cool.
So why don't the UK 2-year and start with there?
Cool. So let me just pull up maybe the UK. You know what? We don't have the 2-year. Let me try we have the 1-year.
Okay, that's good enough. We'll see what's going on there.
Cool. So that's a pretty big breakout, huh?
For sure. And it really caught people off guard. And so I'm looking at this. You have to forgive my eyes. We went from basically zero. What was that earlier? This a couple months ago, and we're now sitting there and
around 600 or 60 basis points. Sorry,
60 basis points. Now, for those
or a 600% move, right, Kevin?
Oh, don't do that! Oh my God.
All right.
So, Rob, I don't know if you have time to watch charts anymore. I know that you were once a trader / strategist, and we were just kind of shooting the shit and laughing about the last time you were here a year ago. You had this great trade to buy Freeport with it when it was in the single digits, maybe, I think even. So I know you're watching markets. What did you have a chance to look up from your screen and watch to see the carnage in there? What do you kind of make of what's happening?
Yeah, I'm not following the carnage that closely, but maybe I'll ask you some questions. And
sure.
So if we're kind of like looking at this global yield matrix here, and these are all the countries on top, you still have a lot of yields here that are negative in the 2 years. So if rates are selling off on the short end, kind of like across the globe, like, what do you make of these negative rates, though, in a bunch of countries?
Well, I think a lot of Europe is still negative. And even though Europe, we saw a situation where they are starting to price in a hike for next year, I believe, we still have a situation where even if they hike once, which would be kind of not what the ECB is guiding for, we're still going to have negative rates. And so it's a kind of a function of too many of those European countries with the stupid negative rates. And who knows if they're ever going to get out of it. They weren't the ones leading the way. The real kind of excitement for this week was all in Australia.
Yeah.
And Australia was the contract that was just getting sold, and it was getting hammered. And I'm not sure.
Well, there was those 2 days in the Aussie market where that 2-year just exploded. But you have to think, though, over the last few weeks, even the Canadian 2-year yield had an extraordinary move. It's the point is it's a global move in rates. Like
Well-
there's very few countries that have left this unscathed from this recent move.
Right. So now I see you've got what do we have there that we're looking at, Rob? You got the
Canadian and the Aussie 2 years. So this is the move in the 2 year going from 0 at the end of September. We're at 3 bips to 67 bips right now. That's a huge. So is this like why did all these rates reprice all of a sudden? Is that just kind of was there one catalyst or?
There wasn't one catalyst. It was a couple of banks. It started, I think, in Poland. Poland raised kind of out of the blue. We saw that the UK got very hawkish and that they said that they're going to bring forward rate hikes. And I think Australia might have done it a little, and New Zealand did it as well. In essence, what's happening is that the central banks are getting nervous about what we see as the elevated levels of inflation. And that old, when they tried to do the flexible average inflation targeting, the FAIT, F-A-I-T, the reality is that many banks talked about it, or central banks talked about it, but now that it's here, the inflation that we had always kind of worried about, markets are saying, whoa, now maybe this won't be so easy to sit through as we thought. And it didn't help that we had people like Jack Dorsey talking about hyperinflation, all sorts of big name people getting out there and talking about the problems with this inflation. And regardless of whether you think it's good or bad, I think that we can all agree that the central banks seem to be panicking a little bit, at least with their guidance. Now, granted, nobody's really tightened that much so far, but just even the signs that they're not going to stand in there as much as we thought and do it is actually making markets nervous, because a lot of these markets at the front end, these traders use an enormous amount of leverage, and they're doing these trades and they're levering up the front end and putting these trades on. And so the moment that we get a situation where things might not look as safe as we thought they were in terms of the guidance from these central banks, these guys puke it out. And we saw this. There's a very famous hedge fund that trades in this, and they got tagged for 11% this month. Wow. And I know you might say that's not a big deal, but these types of hedge funds, 11% is an extraordinarily large move. These are the type of funds where 11% should be their whole year.
But the interesting part about it is that obviously the one easy thing to kind of blame is that, okay, inflation is running hot, therefore central banks are going to tighten and there's going to be this response. But you would think that with these inflation numbers the way they are, and everyone talking secular, that this would also be starting to reflect on the long end of the curve, and it hasn't, right? And so if we go and look at, let's say, the 10s and 30s out on some of these, particularly, let's say the U.S. 10-year, and then actually even let's go to U.S. 30-year.
I think the 530 is a great spread to bring up.
Well, no,
can you bring that up, Rob? Like the 530s?
Sure, absolutely. So,
the point though, we're gonna. That's
because I think
that's the flattener in full
right,
swing,
and I think
right?
that shows you what we're seeing there.
Yeah,
I think Patrick. That's a great point, because if inflation, it depends what kind of inflation, but if it's like runaway inflation and the market's worried about runaway inflation, then you should really see the curve steepen, right? The long end should sell off, because all of a sudden...
the Fisher equation, you're like the idea that the inflation has to be discounted into the long rate. Oh, come on, Kev. You're going to like bust my balls now?
Such a monetarist. It's not even funny. You know that famous Fisher, there's a picture of him with his 1979 Pontiac Firebird or whatever it is, and he has MV equals PQ on his license plate. I'm going to get you that.
Yeah,
put on
sure.
your 2002 white Hummer that you have.
No, more importantly, I could put it right beside my Lacey Hunt poster.
That's right. So I interpret this as the bond market realizing that if the central banks panic on inflation and raise rates, they're going to slow down the economy.
Right.
And I think that they're looking through this and they're saying that we're going to actually get a situation where this will slow the economy. And I think that's what's going on. And I also think that to some extent, this is just levered traders. And then that's the part that...
whoa. So
Yeah.
you actually think that this is just a liquidity-driven thing and that this isn't actually a reality that the curve is going to keep flattening?
So, no, I didn't say that. I said I think it's two things. I think it's one is that the bond market is expressing an opinion that any rate hikes will slow the economy and slow inflation and therefore most likely, stall it out.
Yeah.
And I think the other thing to remember is that the bond market was quite worried about flexible average inflation targeting. If you think about what, long bond, U.S. long bond holders' worst nightmare, let's put aside default because, a currency issuer should never default in their own currency. So you take default off the table. The next thing that's the most worrisome for someone who owns the 30-year is inflation. And previously we had a Federal Reserve that was going out and saying, listen, we're going to let inflation run hot. We're going to let inflation run hot. And it made sense in that environment for the curve to be steep. And you see people selling the long end because they're worried that their Federal Reserve is going to do this. Now it seems that we got some inflation and all of a sudden the Federal Reserve, and I actually don't think it's the Federal Reserve. I actually think it's all the other central banks are panicking and saying, oh, whoa, this is scarier than we thought. We got to raise rates. So it's a rejection almost of the average inflation targeting. And given that it's at least at the margin, it might not be a complete rejection of average inflation targeting, but at least at the margin, it's enough of a rejection that we see people go, oh, geez, it's not as bad as I thought. I'm going to go buy the long end. That's my feeling. Anyways,
what I wanted, Rob just here pulled up. Rob, why don't you talk us through? So you're throwing the ISM up here and then throwing it against the curves. What are you looking at here?
Yeah, so I think like putting this in the context or framework of a 30 or 40-year chart, just this is ISM. I'm just going to throw in a horizontal line on 50 so we know where kind of expansion contraction is. I'm going to change this from log because that's ISM. So basically, these are kind of all the cycles depicted by ISM. So ISM above 50 is expansion, below 50 is contraction. And so this was the COVID decline. This was the mid-cycle decline sort of in the 2015. This was the decline in 2008, 2009. And then you have all these kind of other recessions, 2001, 90s, and follows a pretty general cycle of ISM troughing, peaking, and then going in its merry cycle way where it continues to sort of do that, and then having these major declines add recessions. And my observation and the observation from this chart is that the yield curve follows kind of a very similar path and is able to outline the economic cycle pretty effectively as well. So if you look at the 30-year 5-year or the 10-year 2-year, basically if let's go back to the 90s, you had the yield curve steepen as ISM rebounded, and then they flattened for a very long time. And then they steepened as the Fed inflated the economy. And then once kind of the market started sensing that the Fed is going to raise rates or ease off, they started to flatten out and flatten down to the next recession. And then you had a steepening and then a huge flattening for about 10 years. And now you had a steepening. And I guess right now the debate is the yield curve going to steepen? So we just said the 30-year might not be the best representation because that's a really long time frame or a really long duration to think about. But even the 10-year, 2-year, I'd be curious to hear your thoughts. So my takeaway from this graph is that ISM has already peaked. It's unlikely to go higher. I think going forward, we're either sort of flat to moderating, depending how fast depends on a lot of factors, including inflation and geopolitical and all this other stuff. But I think from here on in, we're generally flattening. We're generally moving sideways or declining. And I think in that environment, you're just going to have a continued flattening of the yield curves, whether it's the 30-year 5-year or the 10-year 2-year. So I think that's I've never traded rates, but if I were able to put on trade, that seems like a pretty sensible one to me based on this framework. I don't know what you think about this, guys.
Well, I want to jump in here and ask you that's the ISM, right? The international what is it called? The ISM Purchasing Managers Index, the PMI.
Yeah.
You have how many years of data there that we're seeing?
Since 87.
I could be mistaken, but I'm pretty sure that when you have that other competitor of yours, the one that's black and yellow, that you don't get that much data for that. I actually like, because this is one of the series that I like a lot, and I always have my trouble going back in terms of time and getting it. So there you go. So can I ask, in terms of those purchasing manager indexes, do you have all the different countries, and do they go back? Do they all go back that far?
Yeah, so we don't have all the countries, but I'll show you the countries that we do have. And if we were to open up a new graph so we don't lose this. And by the way, I think it's okay to say Bloomberg, or can we not say it 3 times, or else we like Beetlejuice comes out, like Bloomberg's cousin. And
well, you said it twice. Don't say it third.
I didn't say it third. I just watched that movie the other day, and it's much different as an adult than as a kid.
There's so many movies like that you watch, and you're like, oh God, I didn't realize how many double entendres there were there.
Yeah, exactly.
So Rob, the ISM data is tough to find, and it's great that it goes back so far. Do you have the ISM Global by any chance?
So we have a bunch of, we don't have it aggregated globally, but we do have a bunch of indicators here on the World Economic Dashboard, which gives you like a quick way to sort the G20. So if you wanted to look at like industrial production, you could sort it, and then any one of these you click would open up its own chart in the G chart. And then these are just kind of the major indicators. And then if you wanted to search for a specific one, you would go to this advanced search. You would type in ISM. You would search by economic data. Oops. Sorry, it's not ISM. It's
National Purchasing.
It's PMI.
PMI.
Sorry.
There you go.
I'm like, what is going on with my brain? Yeah. So you would then have the PMI here, and so we have that here for a lot of countries, depending on what our service provider is giving us. So if you wanted to look at something like Germany or France or whatever it is, we have that here. So that's a quick way to find it.
That's awesome.
What amazing resource. Just you have so many things that you can look up. It's just you could probably spend days on here and not even get to everything. Anyway, we got to just talk on some individual stock names, and I just need to talk about Tesla. Like, can you pull up just a standard clean chart?
Do you mind if I add short interest?
Sure. So we can talk about the squeeze, but just shorten that up just to be looking at the last like 6 months maybe or something, just to really highlight. There was this reversal earlier this week, and everyone's there's the blow off top, and. Just like that, it just goes screaming to another 52-week high. This thing just does not quit. It's unbelievable, this move, eh?
If you didn't know what this chart was or the market cap or whatever, is this one of the most bullish charts that you could ever have?
How many trillions can we tack onto his market cap if it just goes bull?
but this triangle is like
the big horizontal triangle.
It looks like one of those cup and saucer formations, doesn't it? Right before it takes off.
Like if you didn't know what this was or like the price here, wouldn't you say this is going to 2,000 pretty easily?
Well, maybe it is.
I think I'm trying to make that point subtly. Yeah.
So, but what I want to talk about here before we go off too much topic is like when you pull up the chart on ARK. Kathy Wood's ARK, the ARKK, which like 11% of the holdings of this fund is in Tesla. And this thing has not even, it hasn't even broken out or even seemed to have any real response to this extraordinary move in its largest holding. And I think it really only shows how structurally weak the vast majority of our other holdings are. Where like Tesla is the only thing keeping this up. Like maybe we can take a quick peek at some of the holdings inside of ARK maybe we pull up in lots of charts. We can look at just some of the different charts of by market cap or something here, Rob. But it's just amazing that after such an extraordinary move on such a huge holding in that fund, the fund can't even break out of its range.
Yeah, so what I did was I pulled up ARC and just the holdings page or the holding snapshot, and so these are all the holding snapshots, and then you could change the time frame here. So this is over the past 3 months, the percentage change. So you're right. So Tesla is kind of the biggest percent gainer here. I don't know what I did here. Let me just try and change it to 1 month. But then you see how many stocks are actually not doing that well on a 3 month basis. So kind of like all the other stocks here, and you can see the weights here. And then Patrick, as you suggested, there's this really nice function called lots of charts where you can, instead of just loading the constituents of an ETF here. So I'm just going to pull up ARC, and then you wanted to look at it on the past. Let's look at a year-to-date basis to really see. So Tesla's kind of definitely breaking out here.
But go by market cap. So
yep. So let's do that. Sort by market cap, high to low. Yep. So Shopify very flat. Square pretty flat. Zoom. Coin looks pretty good.
Yep.
Hey, this is a pretty funky feature. I like this. I didn't know about this. This is pretty wild.
So you could take it's an awesome feature. Yeah.
Yeah. Lots of charts.
So you can do that with any ETF?
Yeah, you could literally take any ETF, you jam it in this holdings of ETF section right over here. So pick one ETF.
Let's just do IBB for shits and giggles.
Yeah, because you just wrote about that. No, I don't read your stuff. Sorry. No, I didn't.
Someone told you.
Yeah, someone told me it was. But you can see, and you can just basically go through all of the components, the individual stocks in that make up the IBB.
Oh, that's nifty.
Yeah,
right. You could filter them by market cap, which is cool because you always want to start by focusing on the largest components rather than having it mixed with just a bunch of those smaller little one-offs, right? And just sort of see where the turn is happening for the entire basket.
Yeah. Can you get back to the ARC? Can you imagine Kathy's performance if she didn't have that?
Yeah.
Oh, she'd be eating it.
You know what's interesting is I was kind of if you look at all the charts this year that looked really bearish, like halfway through the year, like Bitcoin, and kind of like everyone was like, this is it, this is the head and shoulders, and then it's sort of like rallied and now making new highs. I'd say Freeport is another one where I, myself included, I thought that was like a huge, like if we just take out this latest spike, this looked like a pretty big top. Like it was rounding here. It was kind of in here. It was testing the support on really high negative volume. And I thought for sure this thing's going to roll over. And then it sort of just like rallied through and making new highs. Tesla obviously did the same thing. I think this year has all been about kind of like bear traps and just everything rallying, and that's
yeah. But I mean, really, what we had was an extraordinary run into the first quarter and slightly into the second quarter of the year, and we've had a 6-month consolidation. It's like in typical fashion, technically things overextend and then they backfill and retrace and settle down. But the thing is that some of these things, like right there, look at the small caps. Like that's a over a year sideways consolidation or near a year sideways consolidation. If that bullishly breaks on the upside, it's unwound. It's overbought state. It could go. It's going to be really interesting to see how things play out for sure.
There you go. It almost sounds like Patrick thinks Tesla's going to $2,000.
Oh my God! Don't put words in my mouth.
Isn't that one of your
might actually hold me to that?
Isn't that one of your nacho retracement levels?
On what? Tesla? I'm not gonna say anything else. All right.
Can we just edit out that part where he saes it's not gonna, and just kind of like have that little sound clip and play it all over? Kind of Tesla going to 2000. Tesla.
That's right. Do that little trick that they do on all the things where they cut things terribly and make it sound like that. So listen, let's talk a little bit. Oh, do you want to actually talk about Bitcoin? You brought up the chart, and I think that Patrick was gonna read the tea leaves of this. The asset that shall not be named.
The asset that shall not be. Well, the asset that shall not be named. It's after the launch of that ETF, it kind of had a big burst and it's been consolidating. But the only observation I'd make is that this is the bulls still are in control of this price action. And it'll be really interesting to see whether or not they defend the price during this consolidation, because very similar to what happened last month when it consolidated before the breakout, long as they can dig in and hold the line, this could be the launching pad for a move to all-time highs.
There we go. Patrick is bullish.
I'm not.
Rob, I have a question.
It's again not my forecast. Oh my God.
I have a question for you, Rob, in terms of with all these different currents, I don't know. I almost called them currencies. Let's say coins or cryptos. How do you keep up? Like, which ones do you have, or how does it work in terms of where you grab your data and what do you publish?
We don't have a lot of crypto stuff on here. It's something that we get asked for a lot. And I'd say over the past 5 years, one of the reasons that we haven't had a lot of crypto on Koyfin is because I was pretty skeptical of crypto for a long time, and probably still am, but less so. I think kind of like the how long it's the duration and the longevity of it has surprised me. And so I think we'll need to get a lot more crypto data next quarter. And then actually try and get some interesting stats on crypto, like on-chain analytics, and see kind of like be able to visualize how many wallets hold a particular crypto or how many wallets are selling. I think that'd be pretty cool. But crypto is so I think it's really cool from a trading perspective because it's a currency. It's I apologize, Patrick, if I said that, but it's like a currency because there's no fundamentals backing it, and it's all supply demand. And so when you have something like Shibu or Dogecoin or whatever it is, and you see those breakouts, and again, if you didn't know what the asset was, those charts are trading very technically in terms of how they consolidate, how they trend, and so I think it's pretty cool. And we'll need to get more data on crypto on Koyfin for sure.
Do you know what I think you should do, Rob?
What's that?
I think you should get the Island Boys to do some consulting.
We should sing an Island Boy song.
Oh
I mean,
God,
we have their singing
bad.
voices, so
Yeah,
so
that is
like,
true. Yeah,
like
we
don't need to have any
all
singing
my hair,
talent.
so I can't do that haircut.
If they're on the Market Huddle and you guys don't invite me on that episode, I'm gonna be so upset.
Somehow don't think that they're gonna want to come on the Huddle. But listen, Island Boys, if you want to come on the Huddle, sing a song and tell us your story, you're welcome anytime. Okay, so Rob, let's talk a little bit about your product. Since we last spoke a year ago, or at least I last spoke to you a year ago, a lot of things have changed. You've recently gone pay. Why don't you tell us about what you're trying to accomplish, the experience of going pay, and just kind of the evolution of your product over the last year?
Yeah, it's been quite a journey. And so just the elevator pitch for Koyfin is it's a financial data analytics platform. And basically in a world where there's a Bloomberg on one side and Yahoo Finance on the other side, I felt that there was not enough, there was no one attacking the middle, no one providing kind of professional grade data analytics at an accessible, affordable price. And that was intuitive to use and user friendly. And that's kind of what we're building on those dimensions. And so one thing that we believe is to have a really significant and generous free offering, which we've had for a long time. And we're able to get over 200,000 users using our product. And in June, we launched our paid plan. So basically, there's still a free version, which you could go and sign up and start using. And then some of the features are then walled off or behind the paywall. And you could see all those things if you go under your profile, plans and billing. And so we have a plan that's a $35 plan. We have a plan that's a $70 plan. I'd say for most investors, the $35 plan is pretty significant and does everything that Koyfin has to offer. The reason to get the $70 plan is you get more years of historical data in financial statements. So if you're a financial analyst and you want the full history, that's there. And the other thing is the mutual fund support. So kind of being able to access mutual funds, and that's in the $70 plan as well. And Kevin, your question on kind of launching paid plans and what we've learned, I'd say it was kind of it was two different worlds in terms of how we thought about our product, how we thought about our customers for before when it was free and now that it's paid. And that we're just learning so much about how users are using our platform, what they're paying for, what they're not paying for. And so we're iterating on that continuously. One of the things that we introduced recently, which is really great, is Reuters News. So to the extent people are interested in macro, which I think a lot of listeners are, we now have these news. If you go to market news, broken out by global markets, so you could see it for different markets. You could see it for macro, let's say in debt markets, commodity markets. So all this is Reuters News. You could click on it. It shows up right here in the app. So this is super interesting. Pretty soon we're gonna be rolling out the ability to search news, search transcripts, search filings. So that's going to be pretty exciting. And then in terms of like what our users use us for, the number one thing is still our graphing. Our graphing is really our bread and butter. That's the number one feature that users use us for. And then the second most popular feature are these My Dashboards. It's this ability for me to create my own dashboard, whether it's a watch list or a watch list with two separate charts, and these widgets are linked, or it's a dashboard with 4 charts that I could connect these charts. And whenever I just show you here, if I drag a symbol into here, all these charts are now going to change. So you could customize these charts. This is my EPS estimate chart. This is my price. This is my normalized performance. This is my margin. So you could customize this however you want. And really be able to then see kind of how the trends in the data.
So Rob, can I ask, how long ago did you start Koyfin?
March 7th, 2016.
2016. So back then it was just you. Now, did you hire a programmer right away? Like, what was the humble beginnings of Koyfin? What did it look like that first year?
Yeah. So when I started thinking about Koyfin, and the reason I started thinking about Koyfin is because I was at a hedge fund. I left the hedge fund and started looking kind of what I'm going to do next. Still wanted to follow the markets, but my company wasn't paying for Bloomberg anymore because I wasn't working. And so it was the first time in my life where I actually had to go out and see how much it cost and actually have to pay my own money for it.
That's right. And you had the heart attack.
And I was just like, geez, it's like not only is it $25,000, but you have to sign a 2-year commitment.
I know the 2-year, and then it rolls. And if you don't tell them to give them the heads up, it keeps going.
And I'm like, what? And I'm just like, you know what? Like, I'm willing to pay, let's say, $1,000 a month or $500 a month, which is still a lot of money. But I was like, it's worth it to keep up with the markets. And I went out there and I just said, what's out there? Let's say my budget is $500 a month. What's out there, and I just didn't find anything that not only has so that was the first time I started using TradingView, which I think is an excellent product. Yeah. But TradingView is prices, and it has a lot of really great functionality related to charts and prices, but it doesn't have fundamentals. It doesn't have macro. It doesn't have dashboards, and that's what I wanted in my own process. And I thought there was a big opportunity to build something that incorporates those other things into a TradingView like UI or something that's more modern and modular and stuff like that. So I had never built a software product before. And so I was introduced to a company that had some developers in the Ukraine and started working on Koyfin with 3 developers and started iterating and basically, started seeing some results and got excited about it and decided to do it full time. Raised some friends and family money, hired some more engineers. We were able to get social leverage, Howard Lindzen, as our first kind of VC investor.
Oh, I didn't realize that Howard was one of your first investors.
Yeah, so Howard was our first VC investor. So they did our pre-seed round. And then Craft Ventures and Valor Equity Partners and Social Leverage, they participated in our seed round. So we did our seed round about 2 years ago, and then we'll be looking to do our Series A pretty soon as well. Now that we started monetizing.
So you've gone from 3 developers in the Ukraine and you to how many people work at Koyfin today?
Yeah, so we have a pretty large office in Kiev, Ukraine. We actually have an office there, which is interesting because in the US we're fully remote. And we have 6 people in the US and about 20 people in Ukraine, and we're growing in both regions.
Wow. And so did you ever imagine that you'd be here so quick? Because to me, that's quite impressive that you've gone from 2016 from a former hedge fund trader or buy-side trader that was, didn't want to pay for his Bloomberg to now this big product. Did you ever imagine it would be so fast?
I mean, I think in some respects, I think it's slow because it's, I look around and some of these crypto companies are like $5 trillion after like 3 months. But, if I can actually, I wanted to share, so Liberty, who's on Twitter, who's great. He did a blog post and we sent them some basically screenshots of that's me and my son Archie, and then we sent them some screenshots of what Koyfin looked like in the beginning. So this was kind of like my pitch when I was going around pitching Koyfin. I was like, look, there's going to be a menu and there's going to be a chart and a graph. And people were like, I don't get it. And I'm like, no, it'll have everything. This is going to, so.
It's like the pictures of MS-DOS Windows number 1.0. It's kind of like archaic looking, but it's quaint to look at.
And this was the first version that we developed with like our designer, and you could see like there was a sidebar and there's a graph, and we had these ugly yellow blues, and so we were on the path of building Koyfin, but yeah, it went kind of like from looking like this to now looking like this. So there's been a lot of iteration.
And that's terrific. So listen, why don't you tell people where they can find it, how they can sign up and check it out, and give us the spiel.
Yeah, absolutely. So if you go on koyfin.com, it takes under 10 seconds to sign up. Start using it, clicking around, and then you can always upgrade if you feel that it's going to be widely or heavily used by you and you want access to those premium features.
Well, that's awesome. Well, Rob, it's been a pleasure having you on. For everyone, go check out Koyfin. It's a product that I actually believe in, and I think it's really important that Bloomberg has some competition. So, we don't have many real sponsors, and you're one of them, and we're proud to be associated with your product.
Cool. Thanks so much for your support, Kevin, Patrick. Appreciate it.
Well, thanks a lot, Rob.
All right, Patrick, it's time for This Week in Trading History, and you just couldn't resist, with Jack Dorsey talking about hyperinflation. You had to...
Well, I mean, it is also on the calendar. It's not like I could really decide that, but it's convenient. It was convenient that it happened.
How convenient.
But you know what? I just thought, like we've talked about it in the past, but I just like the story. I'm going to give it a little bit of a shot here, but we're going to talk about October 25th, 1923, when it was the peak of German hyperinflation. So there was a time when an average German carried billions of marks in their pockets, but couldn't buy nothing with it. A loaf of bread cost 200 billion marks. A week's pension would not even buy a cup of coffee. Restaurants stopped printing prices on their menus because by the time the food arrived, the price had gone up. One guy drank a cup of coffee that cost 5,000 marks, and by the time he ordered his second cup, it cost 9,000 marks. Right? Like, so this is like a crazy story. So like Germany lost the war, and the Treaty of Versailles imposed huge fine on them, something like 132 billion marks, which was like 31 billion US dollars, which is a lot of money back in the 1930s or 20s, right? And in order to pay off the debts, the government turned to printing money, which at least in part was used to buy foreign currencies to pay the reparations. And so soon there was too much money chasing too few goods, and inflation spiraled out of control. At first, inflation crept up slowly from 4.2 marks per dollar before the war to 48 marks per dollar when the treaty was signed. But then it started to accelerate rapidly. The first half of 1922, the mark was at 320 marks per dollar, and by the end of the year had dropped, and it was trading at 7,400 marks per US dollar. Eventually, The mark touched a mind-boggling 4.2 trillion marks for $1 US.
Trillion.
Not with a T. It's unbelievable. Employees back then brought suitcases and backpacks to work on payday to collect their wages and ran to the nearest shop to exchange before the exchange rate changed for them to buy food and other things. Banknotes of higher and higher denominations started turning up every few weeks. When the 1 trillion mark note came out, few bothered to collect the change after it was spent. The hyperinflation peaked on the 25th of October in 1923, this week in history. The banknote denominations rose to $100 trillion mark bill. The currency had pretty much lost almost all of its meaning back then. Strangely enough, goods were not actually in short supply. It was simply that there was no stable currency to buy them with. The only objects of real value were tangible assets, diamonds, gold, arts, antiques, and soon the country crumbled to petty thievery. People began stealing anything: soap, hairpins, copper pipes, gasoline. It was clear that a radical monetary change was needed to halt the permanent depreciation. So in late 1923, the mark was replaced by a new currency, the Renton mark, which was backed by mortgages on agricultural and industrial land. The value of the Renton mark was fixed to the old exchange rate of 4.2 Renton marks to the US dollar. The situation normalized, but the country was never the same again. The lost savings would never be recovered. And there was a different temper in the country, and the temper that inevitably Hitler would later exploit into power. And it was a crazy time. I didn't do justice to the story. There's this fantastic book called The Lords of Finance that talks about monetary policy through the 1930s and 40s. During that whole period, just a phenomenal book that goes in depth about monetary policy and just how things were in this time. It is a must read for anyone that finds this story interesting.
So, Patrick, I feel bad for all the human suffering and all the, the poor Germans, and little did they know that Bitcoin fixes all this, and they just needed to adopt Bitcoin.
Yeah, if they only had crypto back then.
That's right.
It's anyway. All right, let's move on.
Okay, Patrick, it's time for skin in the game.
Yeah.
And I lost.
But boy, did you make it interesting. Like, literally, I was like, I just couldn't believe it. Okay, first of all, let's talk about the bet. We were talking nat gas futures, and you straddled it. You gave a 40-cent up or down, so it was the range of 505 to 585 range. And it was, does it close in, or does the straddle pay off come Friday's close? Right?
Yeah.
And nat gas started out of the gate busting through 585 on Monday. Like, it did not even waste any time to give me an ulcer. I'm like, what the hell is going on? And like, it ripped to 620 by Wednesday.
I was looking good. I was looking good on Wednesday.
You were looking great. And then it just had the feet kicked out and just came right back in. But that's typical of actually the issues with straddles all along. You have to pretty much, once you get a big move, you have to find some tactical way to make an adjustment, because mean reversion almost always happens. And it's like you should have.
I should have. You know what I should have done? I should have delta hedged my beer bet.
It wasn't a beer bet. It was a burger bet.
A burger bet. I should have gone delta hedge my burger bet. I'd like to short half a burger up here, please.
Anyway, all right. So quickly tell the rules and let's make a new bet.
Okay. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager. I'm having trouble speaking today, Patrick. And the other guy chooses which side of the bet he wants. Every wager.
The beer has nothing to do with that, right?
Every wager needs to settle by the next episode, and the currency for the wagers is everyone knows it by now. Okay, the winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions. Okay, so Patrick, what are we going to do?
All right. So I want to do some grains.
Oh,
And
come on!
so-
I thought you were gonna.
No, I'm not.
doing.
I'm not doing the. I'm not doing the
Okay.
currency.
Okay,
I'm
let's
not
do
doing
some
it.
grains.
So, but
You know,
listen,
nobody's
so
talking
wheat,
grains, so it'll make
yeah,
it interesting.
wheat and corn have like wheat's been breaking out. Corn has been put in a bottom, and the laggard has been the beans.
Beans. Okay.
The beans, and so I want to place a wager on the beans, and I'm going to make this crazy simple. We're doing the January 2022 soybean contract,
Yeah.
and over under straight up. Is this a bottom? Is it going to get bullish
That's
or
real
or
easy. Over.
Over?
Yeah.
All right.
You know me.
Let's,
I'm always bullish on grains.
All right. You're bullish the beans.
I'm
All right,
bullish to
buddy.
beans.
All right. So over under for next Friday's close on the beans. What do you want to bet?
I feel good about this one. I'll do a pitcher.
Let's do a bottle of wine.
Really? Okay, you're on.
All right. But you're not delivering a box wine this time. I know the joke is funny, but I actually want a real bottle of red. And it wasn't that you delivered a box of wine. It was white wine. It's like a double punch in the gut. At least.
Are you sure it wasn't rosé? I might have got you.
No, you got me white wine. It was a box of white wine. I was like, you're kidding me, right? Like I went and got you like a freaking $100 bottle of freaking Italian red. And you turn around and bring me a $40 box of white wine. Yeah, what a douchebag! You win the douchebag award.
Okay, but you gave me 750 mils, and I gave you like 2 liters. So who's
Quantity,
the douchebag?
Okay.
Who's the douchebag?
All right. So the beans over under Lena. It's we'll use the on the January contract the 1249. We'll use 1249. No, 1250. Let's make it around 1250.
I love how he's taking an extra penny for himself there. But that's fine. Whatever. Okay, no stupid questions. Lena, hop on and save us.
We have quite a few today.
All right, let's do it.
So, first question. Hi, Lena, Kevin, and Patrick. Firstly, thanks for the podcast. I've been listening for a couple of months, and it's great to hear your perspectives on the market each week. Kevin, congratulations on your rant last week. You reminded me of the saying, the only thing necessary for the triumph of evil is for good men to do nothing. Well done for not doing nothing. Now for my question. For people who trade full-time for their personal accounts, a lot is riding on the capital that is held with their broker. Is there anything that can be done in relation to the credit risk of the broker? Do traders have multiple brokers? Or is this more of a situation where you shrug this off, thinking that if the broker goes under, you've got bigger problems to worry about? Thanks again for the show.
So thank you for the kind words and great question. It is actually a terrific question. And I don't know all the rules throughout the world. So one of the things that you need to be aware of is that it will vary in the jurisdiction that you're in. So I can speak in Canada. There is generally a limit for brokerage accounts to be insured by kind of the collective regulatory agency. Meaning they all get together and then there'll be a limit. And I don't know what the limit is in Canada.
Like $1 million or something.
It's $1 million, or like it's $250 on bank accounts, but I think it's more on brokerage accounts. And so one of the things is if you're find out the rules about the collective limit, and if you're below the collective limit, then you don't have anything to worry about. So you're going to be fine. It doesn't matter which broker you're at because basically you're taking the risk of the whole group of brokers. Now, if you are over the collective limit, then you should be thinking about it. And your question about whether clients have multiple brokers, for sure they have multiple brokers. And this was especially evident during the great financial crisis. Some hedge funds would only have one prime broker because you give them more business. It ends up being they give you a better rate. And some hedge funds learn the hard way because if you went to Lehman, for example, Lehman in London, you got more leverage and it was more aggressive pricing than Lehman in New York. Now, when it went to time for the different bankruptcies of Lehman, the clients at Lehman New York did a lot better than the clients at Lehman in London. So after that, a lot of these hedge funds realized the credit risk, and some had actually figured it out way before that. But let's just say that everyone realized that this was an issue. Now, back to the retail side, if you go and look, a lot of your brokers will have supplemental insurance. And I'll just use Interactive Brokers because I know I looked at theirs. So if you're above the collective regulatory limit, then what happens is Interactive Brokers has an extra insurance from, I think it's Lloyd's of London. And I can't remember what the number is, but I think it's like $10 million. And so a lot of times different brokers will have this extra supplemental insurance. And so you should go look at that. And then from there, if you're lucky enough to be above the supplemental insurance, then great. But it ends up being that you should think about the credit risk of the other side of your trade. Now, a quick note. One of my big issues with crypto is the fact that people go and send them to these various exchanges. And the reason that without thinking about the credit risk. And the reason that I am very aware of this is because when I was first trading crypto back when it was, $100 on that rally from $100 all the way to 2,000 and back down to $200, I was doing interlisted arbitrage between the various exchanges. And there was a permanent arb at Mt. Gox. And I remember the young fellow that was working with me, he said, "Oh, let's go do this." And I said, whoa. Anytime that there's a permanent arb, meaning that it's something too good to be true, it isn't. So I remember we sent Mt. Gox a coin, we tried to sell it, and then we asked for our money, and the money was just weeks, and I don't even know if it even ever came because it eventually went bankrupt. And so one of the things that I realized was that the investment industry, there's all sorts of rules. There's all sorts of regulations. It's got many, centuries of these regulations being created and safeguards in place, whereas in crypto, there is nothing. Now, it has gotten a lot better since those dark days of Mt. Gox when I was first trading. And obviously, when you look at a credit like Coinbase, it's much better than it used to be. But having said that, Coinbase is no JP Morgan or, Bank of America. And people should be aware of that, and they should think about that. And think about that because I'm a big believer that you should be putting it into your own cold storage or whatever it is because you need to be careful about the credit risk that you're taking. And so I think for most of us, it doesn't matter on the brokerage sides, but for the cryptos of us, crypto traders amongst us, I think that you should be very aware of that and make sure you're up to speed and know the risk you're taking.
All right. Lena, let's do the next one.
Second question. Hey, guys and gal, do you think that the BITO ETF will suffer a futures contango role drag like other similar ETFs? Now that Patrick has gone to the dark side and is publishing income rates on BITO, I'm wondering whether it might just suffer a slow bleed that might make that a challenging trade. Great show. Thanks.
Well, first of all, Massel made me do it, so it's not. I'm not converted. Anyway, but do you have insights on this, bud?
Yeah. So for sure, currently the futures, the farther dated futures, are trading with a big carry in them, and as there is more and more interest in the futures, and that will be created from the BITO. I don't know. How do people say? Do they say BITO? BITO?
I have no idea.
I don't know. Because PITO. Anyways, as there's more interest in this future, I suspect that carry yield will increase. Now, as that carry yield increases, eventually you could also get people that are attracted to the trade and bring it back, the spread back in. But there is no doubt that there will be a drag on performance of the futures one versus a pure cash one. So, for example, the pure cash one in Canada, BTCC.B, that one trades, it's a cash settled index, and it should theoretically, because I think it settles every day, it should theoretically mirror NAV more. The NAV on the BITO will be based on the future, and the future will have an embedded decay or carry built into it.
From the contango of the futures term. Structure. All right. Let's do the next one. Go ahead.
So next one here. Hi, Kevin. Thank you for doing the Market Huddle podcast. I look forward to listening
but not
to
Patrick.
it every
not
Yeah,
Patrick.
not Patrick. Just only Kevin.
You know what? Because this listener is smart. He or she stops at the interviews and just says, "Okay, the rest of it's crap."
Yeah. I was wondering if you could touch on a couple of points that Mike Masters brought up that I wasn't able to understand. I did rewind the podcast a couple of times, as you mentioned. Wink face. Question number 1. When Mike mentioned the perception of the event and the actual event are two separate things, does that mean the perception trade would have a window, time period prior to the event, before the actual event occurs, and then it stops to matter as the market will react to the event?
Okay, can we stop right there? I'll answer that question because it's kind of complicated and we'll do it. Yes. You've got it spot on. Like what Mike was saying was you can trade the actual event or you can trade the perception or the lead up to the event. Meaning that if you foresee that people will make bets going into the event, you can get yourself positioned ahead of those people making the bets, put that trade on, and take it off before the event ever occurs. And that is the portion that he was trying to...
It almost sounds smarter.
Yeah, that he was trying to arbitrage.
That's even more predictable.
Listen, Mike Masters, it was such a privilege to have him on our show.
Yeah.
One of the smartest guys that I've ever spoken to. And it was... Some of his things when he was talking about those, it was kind of a little bit, you had to really listen, but this listener has got it spot on correct.
All right, so let's do the second one.
Part of the question here. So question number 2. Also, when he highlighted that the ARB was full, what does that mean specifically? I can get you the exact sentence if that's more helpful. Once again, I appreciate all the content you put out and have a great weekend.
So when there is any alpha in a strategy, meaning that the strategy has something that you have an edge. So there's, imagine that you go to the horse races and you figure out that the horses that, I don't know, are using a specific brand of horseshoe run faster. And nobody else knows that. And you can go there and you can exploit that because you're buying horses that are having the fast shoe on and the market hasn't realized that. You have that edge. But then when he says the ARB is full, what he is saying is everyone has figured out that the horses with the faster horseshoe are more likely to win. So therefore, that they are priced correctly and there is no longer any edge in the trade.
Right.
There you go. Hope that answered.
No, that makes sense. All right, let's go on.
So next question here. Hello from Taiwan. A stupid question from a newbie, but a macro trade I see on the horizon around the back half of next year is food commodities going up a lot due to all the disruption and all these news of fertilizer plants being shut down while the demand for them is inelastic. The question is, as someone who can't directly trade futures, how do things like corn, wheat, and soybean ETFs work? Are they more like the USO oil ETF with continuous rolling contracts? Still, they'd probably work short-term under 6-month holding time if the view is correct, yes? Thank you for a great show.
So, Kev, let me take this one. And so what I figured we'll just pick on one of them. So let's take the corn ETF. So what I have here is just the website for the ETF provider. And you can see under the holdings that they basically own the March, May, and December 2022 contracts in corn. So they very much like the USO. They are distributed along the term structure. It's not all lumped up in the front month in terms of the way they're set up. And while they will be rolling, and there is going to be whether a gain or a loss in the rolling process, the interesting thing about where we are in, let's say in the case of corn futures, here's the chart on the term structure. You can see that actually it's pretty much in backwardation. And so there isn't too much slippage from rolling now, but that doesn't mean it will always be like this. There's a lot of times it trades in contango. But at least at this moment, there isn't a direct slippage because just of the shape of that term structure. We'll see whether it stays like that in the coming months. But at least from that anyway, it does have the same characteristics. But in this situation, there isn't a heavy carry at this moment.
There you go. Thanks for explaining that to us, Patrick.
All right. You don't have anything to add?
No,
wow, all right.
So well done.
All right. So, all right, Lena, last one.
Okay, last one here. Hi, as a mostly long value investor, I've begun dabbling in selling covered puts and calls to generate income and to hedge and or time position entries and exits. In gravitating toward the higher premiums on offer in the smaller cap high vol names I own for sold calls, or would be happy to acquire at a lower realized price for sold puts, I've gotten to wondering, can options pricing be interpreted for where the underlying stock price might be headed? I would think the underlying should move primarily on individual company fundamentals, the macro picture, general market sentiments, etc., and that options pricing simply reflects actual moves in the underlying time and volatility, but wonder if I am missing out on some deeper meaning. If there's anything to this idea, is there a way to gauge the extent to which option pricing might signal the price action of the underlying as a given strike expiration date approaches, e.g. comparing option volume open interest to the trade volume market cap of the underlying? I always enjoy your show. Thank you.
It's interesting, Kev. Like, I'm going to let you take a bigger stab on it, but in theory, the option pricing should not be reflecting a bias towards where a market is heading. But the interesting part about the whole gamma trading that we're seeing today is that a lot of the way that people position themselves ultimately in options ends up influencing the market and in terms of which way places it can go. But at least from a traditional option pricing, I mean, you were the market maker for a while on this. Why don't you kind of take a stab at this?
So a lot of times you'll see people that'll look at, for example, the shape of a futures curve, and they'll say, oh, the market is pricing in future, corn or whatever at a lower price. And sometimes that's not necessarily the case. Depending on different markets, you could see a situation where that actually just reflects a carry, or that reflects a market kind of specific event. In terms of options, it's slightly different in that people will go and look at it and think that if the calls are more expensive than the puts, that means the market thinks that there's more likely chance that it'll go up in price. And one of the things that you need to realize when you're thinking about option trading is that the relative value of a call or put in terms of implied volatility is more a reflection of the market's interpretation of the volatility around that strike. And so the reality is that if the market might actually believe that a stock will go up, more likely to go up, but yet price the calls with a lower implied volatility than the puts, because stocks go up in a more kind of, they used to at least, they go up at a slower pace than they go down. And so when you're thinking about the relative pricing of calls and puts, you need to realize that it has nothing to do with their belief of the chances of that occurring. It has more to do with the volatility of the underlying if it gets there. Right. And that is, I know it's a subtle difference, but it's an important difference, because if you have a situation where you think, let's just take a boring stock, Microsoft. You think Microsoft, you could have the view that it's going higher as a market maker, but or you suspect that if it goes up 5%, that it'll be relatively easy to trade and there won't be large volatility. Because don't forget, if you sell that option, you are therefore have to buy more as it goes up and sell more as it goes down. And the amount that you lose doing that gamma chasing will hopefully be less than the amount that you earn by selling that option. And that's the whole game, is to figure out whether that amount that you sold it for extra is enough to compensate for the amount that you the chasing you're going to do. On the other side, if you go sell a put, you might say to yourself, listen, I think there's very little chance that Microsoft's going to go down 20%. But I know that if Microsoft goes down 20%, that it's going to be likely that it'll be whipping around and moving around 5-10% a day or whatever, and therefore it's doing it. So one of the things when you're looking at this, don't be careful how you're interpreting it in terms of bullish or bearishness. It has nothing to do with bullish or bearishness. It has to do with the market's interpretation of volatility around that strike.
There you go. You heard it right from the former market maker himself. All right. Alina, where can people submit questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right, folks, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle there on Twitter. We're there every day. Lena gets tired of talking to Patrick and myself, so always give her a good shout out. We can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our latest charts and visuals. And while you're there, please like and subscribe to get our latest content.
Slam that likes button.
Oh, there we go. I'm not very good with what the kids say. And if someone could, if we get enough people on YouTube slamming the like button, Patrick and I'll get tattoos. I'll put on the hair, and we'll get grills. I've been told that's what those island boys have. They're grills. I didn't know what was going on with their teeth. I didn't understand it, but they're grills, and they're awesome singers. Like, they're great. Yes. Listen, big things I expect from them. Big things. Looking forward to the next album. And please, if you could rate and review us on iTunes, everyone knows why. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna and Kev. Where can people find you in that amazing newsletter of yours?
You can check me out on Twitter at Kevin Muir, and you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right, Kev.
Yep.
After show, I need to know, which costume did you pick for this Halloween?
So for those that are just listening on this, we have a great picture. Pull it up here.
It's there.
That's basically what I look like these days. I put on some weight for the COVID. And
You're not that, but for our listeners, he's not that.
Yeah. So, and one of the guys, they're both rather, they're pleasantly plump gentlemen. And the one guy is dressed up like, what is that's the Kool-Aid guy?
Man. The Kool-Aid
man, the guy
that
always busts through the doors or the walls?
Yeah.
Like, and the kids are never that upset about it? Like, can you imagine how upset the parents must be? Kool-Aid guy can never use the door. Like, I'm sure by like
He's going right through the wall.
Fourth time the guy's coming through the wall, like the parents are just like, come on, seriously, the door?
No more Kool-Aid in the house.
Yeah, so the one guy's dressed up like a Kool-Aid thing. Now, I'm kind of nervous about the bottom half of this picture because it does not look like he's wearing anything on the bottom part.
Yeah, I'd be nervous.
What do you think, Lena? Do you think he's wearing anything?
I don't think I want to go there.
Yeah.
Period.
And then the other guy is dressed up like Fat Elvis, and it is magnificent. Like that, there's no other way of putting it. And let's just put it this way: it is tight in all the wrong places. And Lena did not notice, and then Patrick.
So which one?
Patrick pointed it out, and then we're like, "Oh my god, I can't unsee it." And once you start looking at it, you're just like, "Oh my god, I can't bring it."
Let's
back.
not mention it and see if people can also point it out.
Well, we already mentioned it, but they.
So which one are you gonna wear?
Oh, Fat Elvis for sure.
Okay.
I'm not confident enough in my body to wear the Kool-Aid suit.
It's not even it's a suit. It's a
But
body
are you getting
paint.
it that tight?
Yeah, it's body paint. Yeah. Sorry.
Are you going that tight with the Elvis?
Oh,
suit?
of course. Of course. Always gotta go that tight.
All right,
You don't show up at my door trick or treating.
Let's rate this beer.
Oh, it's not very good. Listen, it's sour, so I.
We had a beer that we feature. I'm trying to remember the name.
I
of
liked
it.
one sour, and I there was one sour that got above 5, and I'm gonna give this above 5, but not much. It's a sour. I'm too old to like sours. It's not gonna happen for me. It's just not.
Okay. So All right, first so go. So you, what did you give it?
I'm going to give it a
Above
5.9.
5.9. Okay, so this reminds me. We had a beer. Was it one of the Flying Monkey ones? I think it was. There was one of those.
The crazy sour one. Like really
It wasn't crazy sour. It was actually something like this. It was a little bit sour, but a pretty clean drinking beer. So this if this was right now July, and it's scorching hot outside, and you just want to sit in the shade and have like a fruity cold beer, it would work. Right now, for a fall season kind of thing, it's just the wrong time to be drinking this kind of a beer.
We could have drank it in August if somebody wasn't in Portugal for a month and a half.
Yeah, that's true. But so fair enough. But what I will say is this: I'm going to give it a double score. If this was July, I would have given this a 7.6. But the fact that this is at the end of October, I'm going to have to drop it a point and give it a 6.6. Seasonality. There's a term structure in this beer call here, and so right now. From the period that we're rating this, it's a 6.6, but in the summer, my score would go higher.
Okay. Well, that's fair enough. All right. Did you watch anything good lately? By the way, I didn't realize this. We've never talked about Squid Game. Did everyone watch it?
Yeah.
I watched
talked
an
about it at
episode.
some point.
You watched one episode?
Yeah.
That's it?
That's it.
Are you going to watch the rest?
I don't watch TV. Like, you know what? I'll tell you this. If I was going to sit down and if there wasn't like a hockey game on thing and I'm done the Archer series, then I probably would squeeze in a couple more because it is a good show. I'm not gonna actually shit on it.
It actually gets better. I would say that the first one's a little weird, and I don't know. My son, he loves Japanese anime or whatever it is, and he gave us lots of shit for watching it with the what is it called? The
dubbing?
Dubbing.
Subtitles?
Oh, it's terrible.
So there we go. So maybe this is a generational thing. Because my wife and I are like, we're not going to watch the subtitles and listen to the original language. Like, that's not happening. Like, there's things, and he's like, you guys, and he just thinks we're just full of it and stuff like that. And so, Lena, when you watched it, did you watch it with the subtitles or watch it with the dubbing?
I mean, I understand everything, so I don't have to watch it with subtitles. But I did watch it with subtitles for Luke's sake, and then, the translation was pretty off, so I would stop it every 2 seconds and go, oh, that's not what they're saying.
I know.
What they're really saying is this.
This pisses me off all the time when I watch French shows, and I'm like, that's the wrong translation. They got this wrong.
They translate it literally or something to that effect.
I think it's automated. I honestly think
probably is.
There isn't someone like that's actually proofreading the subtitles.
But dubbing is even worse. I actually started listening to it dubbed, and then I said, this is garbage. And
it's pretty funny.
I got to turn the dubbing off.
Literally, they'll have a sentence, and then the person will keep talking. It's like, hi, how are you? And then
terrible.
They're still talking. And the one actor, the woman that
the crazy lady.
Yeah, crazy lady is so annoying. Like whoever did her overdubbing, like it was so annoying.
It's terrible.
And was she that annoying in Korean?
It's not that she was. Well, I guess you could call it annoying, but she was very, very rough. Let's just put it that way. So like translation didn't really do the justice of showing.
Did you finish the whole episode?
The whole show?
Oh, I finished it. It was easy to watch.
That's cool.
And the games that they play are the games that I used to play.
Oh, that's cool.
School.
Like, so you knew all those?
Yeah. I know all those games. So it was interesting for me.
What did you do when classmates fell through the glass and died? That must have been pretty traumatic.
I pushed them off. No. Those are basically all the games that we used to play after school. So it's kind of like, it's like nostalgic sort of twist to, people who grew up in Korea, but obviously we don't kill each other after that.
Yeah.
Well, obviously.
So another thing that's interesting is like how many people, when they watched it, when they saw all the big amount of loot up there, pulled out their phone to figure out how much that was in US dollars.
Oh my gosh.
I have a question. Did anyone not do that?
Oh, I didn't.
Oh, you knew.
I just kind of, I had an idea because I just know.
I had no
changed
clue. I
roughly.
was like, how much is that? Like, I has no clue. I'm sure everyone else was the same. Most other people or didn't care. They were just like, I don't care.
See,
It's
you're
just
ruining it for me.
considered
Don't,
a lot of money.
Don't.
We're
ruin
not
it
saying
for me.
anything. We're not saying anything. It's fun, though. You should watch it. It's a little violent.
Yeah. Well, my parents recommended it. They're like, "Oh, did you see? There's a new Korean show on Netflix. You gotta watch it." I was like, "What are you talking about?" And then, that's how I watched it.
Yeah, well, that's cool that you got to watch it in like actual Korean. I'm sure it was better that way.
It is definitely better. A lot of the like emotional side of things gets a little bit lost with translation.
Oh, okay.
Yeah, but,
Oh, that's interesting.
overall, still a really good show.
It's awesome that the Korean films of all of a sudden, everyone's excited about it, and it's a real testament to the internet and to our new global world. That
Yeah.
here you have this like kind of, I don't even know, is that big budget or probably not, right? Like that's just kind of some.
I don't know, actually.
And like
I would assume it's a pretty big budget.
Well, I guess you're
considering,
right. It's a decent budget, but it's that this thing has become the hottest show this year, right?
I just wonder what is such an appeal for non-Korean people. Like for Korean people, it's very nostalgic. A lot of the games are the games that they used to play.
No, but I
as
think
kids.
the story
but-
is transcends like race or
It's a little bit sad, right? Like,
Well, yeah. Listen, it's not that far from the Hunger Games.
yeah, it's kind of like Asian
it's-
Hunger Games.
it's a Korean version of the Hunger Games, but it's just a great story, and it just shows you that the world is changing. It's become more global, and I think that's fascinating. And
you can have a full conversation with my parents about it. They're all about it all these days.
Oh, are they? They just think this is so
Yeah.
awesome.
Yeah.
Well, I think it also just it flattens it for everyone, right? It flattens the world for everyone. Now all of a sudden, Korean filmmakers aren't just stuck selling just to Korea.
Yeah,
Now, having said that, you guys are just owning a lot of stuff. Like you have these K-pop guys. I don't understand that.
I don't even. You know
like
what? I
your
can't even
huge
keep up.
hits. Like you guys have got it figured out.
There's
I don't
so
know what
many
it
of them.
is.
I don't even know.
And
I don't get it either.
Isn't the
actually.
K-pop big in Japan, which is kind of funny?
I think it's much bigger in Asia. But I can't listen to their music, so it's a little different for me.
Yeah, well, I'm sure it's bad, but
But it's very popular.
good for them. Like, they nailed it. Like, listen,
Yeah.
we have that idiot Justin Bieber, and it's not like we don't have the equipment. Like
The Americans can have them.
That's right. We've done a trade.
Yeah, we did a trade.
We've done a trade. Oh, that's so funny. Anyways, Patrick, what have you been up to? Eating your moose steaks?
Yes. Yeah. No. I'm heading out to Guelph to go see an old buddy of mine. I think actually he was on the Market Huddle in the early years. John Smith with H silent.
Okay.
Smith. He was on our show.
And he lives in Guelph now?
Yeah, so I'm gonna go have a couple drinks with him. It's gonna be
What's that,
it's gonna be
tonight?
a good weekend. Yeah.
Yeah. How was your
Yeah,
hockey game, by the way? Speaking of which.
Oh,
Yeah,
yeah,
what
I
happened?
went to the Leafs game. It was awesome.
Yeah.
It was awesome. They lost.
Do you
to
remember?
the San Jose Sharks?
Where did you sit?
Oh, it was behind the net in the.
What's your
So-
favorite spot to sit?
where the tickets are free.
Okay, but like apart from that, you must have a favorite spot.
Well, generally, you know what? I do like actually sitting at one of the ends versus in the middle when the scoring action is on that end. The shit part is like when you're on one end of the rink and the other team is dominating on the other side of the rink,
Oh,
it sucks,
it's
right?
boring.
And so, like the center ice one, at least you get a nice part of the play the majority of the time. But it's sort of like it's a trade-off of do you want a good seat that sees the action pretty consistently throughout the whole game, or do you want like those periods where you get to see some kick-ass goals right up front, and then be really far away from other stuff playing on the other end of the rink? I don't mind it. I don't have a preference. I like
As
a
long as
little
there's
bit of both.
beer, he'll sit
Yeah.
and watch the game.
I'll go even in the nosebleeds sometimes. It's
So I will tell you, in the old Maple Leaf Gardens, I had my buddy Andy had these seats, and they were greens. And for those who don't know, in Maple Leaf Gardens, it went gold, red, greens. And everyone wanted reds because you're down by the ice, and that was kind of showed that you were paying lots of money for your tickets. And then golds were pretty good because they were the next, but greens were just kind of, I don't know, like halfway up. And he had these pair of greens right at center ice. And I think they were $60 a ticket. And I used to have.
Oh yeah, you're dating yourself.
Yeah,
buddy.
but that's like, but they were greens. Don't forget, the golds were $100.
Back in 1980.
No, this was in the 90s. This was in the 90s. But they were the best seats.
90s because it makes it.
They were the best seats in the house. They were the second row greens, and I still remember them. I used to leave a standing order with them. I said, any ticket you don't want, I'll take. I would take them, and it was the greatest place to sit. And what's interesting is that Conn Smythe, who I think he owned the Leafs, he sat in the greens as well. And here's a guy that owned them, could sit anywhere he wanted to, and he sat there. And a lot of people think, like in basketball, you want to sit down low. It's cool. You see it and stuff like that. Hockey, I don't think it's anywhere near as good. You want to sit higher. And interestingly enough, Patrick, if you look at where scouts will sit or stand, they often go high up into a corner so they can see the whole play evolve. And they can watch where people are going into different things. So, anyways, I'm a big fan of whatever.
But you know what? Like the thing is that for me, when you're sitting higher up, you're getting the same kind of scope of the game, like if you were watching it on TV. And then it's kind of like, well, why don't I just watch it on TV? What I like about sitting a little bit closer is you can really see their that up close facial
missing teeth.
Yeah. But you don't see how the play develops, and you don't see the different parts.
Yeah,
it's too hard to see. You want to see the whole play.
But then watch it on TV.
Anyways.
Watch it on TV.
Yeah.
You know, like listen, the scouts are scouts. They're doing that because they can't afford the lower seat tickets.
No, honestly, I've been to a lot of hockey rinks, and I've watched.
They
them.
ain't giving the front row goals.
I've seen them
to,
do it. They'll stand there.
To the scouts.
They'll stand there when it's just like imagine there's a bunch of kids and they're playing at the Maple Leaf Gardens. And even though there's nobody in the rink, the scouts will still stand there. They could sit wherever they want. They still stand there. Because they want to see the whole play.
Spot.
It's easier to see. It's also probably that they're used to standing there, so there might be an element of that. But Conn Smythe could have sat wherever he wanted. Anyways, I decide I don't like sitting too close. I think that people pay a lot of money to sit close. I think it's ridiculous.
All right. Anyway, I'm gonna get in the car and go for a ride, buddy.
Okay. Well,
out to Guelph. Anyway, so it was a good show.
Okay.
Have a great weekend, everyone.
You too. Enjoy yourself. Drive safe. Lena, have a great week.
Or you should take an Uber since you've been drinking, right?
Oh my God. This one little tiny little thing that I drank like almost 2 hours ago.
And then are you going to sleep over there?
I think I'm going to be. Yeah, I'm sleeping out there.
Oh, okay. Because I was going to say, because I suspect that you're going to have more than one or two out there.
No. I'm sleeping out there.
Sleeping out there in Guelph. Guelph, watch out. Isn't that where the Mennonites live?
I have no idea. But
I think there's a lot of Mennonites.
You'll find out tonight.
Yeah. So the Letterkenny boys. Okay.
Have a great weekend, everyone.
Take care. Bye-bye.